How Warren Buffett Amassed His Fortune. How does one accumulate $30 billion? It has been said that making your first $1 million is the hardest, and that subsequent millions come much more easily. To a certain extent, that's true, just as it was easier and considerably quicker for the Dow Industrials to rise from 10,000 to 11,000 than it was for the Dow to rise from 2,000 to 3,000. As the numbers get larger, the percentage change needed to reach the next milestone contracts. Increasing money is not the same as, say, hitting 500 home runs, where it is just as difficult to hit the last 50 home runs as it is the first 50. Competitive endeavors such as sports make you earn every statistic. Finance hands you a golden goose, the power of compounding, and makes it difficult for you not to attain some measure of wealth. Nevertheless, there's quite a difference between a mere millionaire and one who can tack 3 more zeros onto green ledger paper. The list of inductees into the compounding club drops exponentially as net worth increases. It's almost safe to say that there are 1/1000th as many billionaires in the world as millionaires, and there are probably 1/10 as many folks worth 11 figures, $10 billion or more, as are currently worth 10. No mathematical formulas or bell-shaped curves, however, can make light of what Warren Edward Buffett, born August 30th, 1930 in Omaha, Nebraska, has attained. There simply is no precedent for it in business history. The world's club of billionaires is replete with sheiks and kings, entrepreneurs, inventors, CEOs, those who struck it rich being in the right place, and those who merely came out of the right air womb. Warren Buffett mustered every ounce of horsepower his mathematically inclined brain could produce, and created a career for himself exploiting the world's financial inefficiencies over and over again. No billionaire except Buffett has earned his entire fortune off Wall Street. Rather, most of his peers began with regular jobs and shepherded themselves up the business ladder through distinguished acts. Only later in life did they try to adapt their skill sets and compound their wealth by playing the quirky, schizophrenic world of Wall Street. Warren Buffett adopted finance and the trading of paper stock certificates as his bread and butter from the start. He bought his first stock at age 11. While his Omaha neighbors toiled for their families working in nondescript positions, the confident Buffett, then in his 20s, ran the world's most successful investment pool from a disarranged bedroom filled with annual reports, Standard & Poor's guides, and plenty of 8-packs of soft drinks. For 45 years, Warren Buffett's business card could have read simply Capital Allocator. His chief job description since the 1950s, one could argue, has been that of a fundraiser. He scours the financial world for sources of cheap money, usually by purchasing a cash-generating company, and puts the money to use, typically compounding it at annual rates between 20 and 30%. Every dollar of value he adds to the process translates into a dollar of intrinsic value for a publicly traded entity called Berkshire Hathaway. The influx of dollars, which numbers in the billions these days, is sucked into Berkshire's perpetually bulging coffers and forms a stack of claim checks his shareholders are only too happy to have retained and reinvested on their behalf. His decision in the 1960s and 1970s to amass shares in this formerly antiquated textile company gives him and his wife, Susie, a nearly 34% stake in the same profits he takes pride in generating. Simply by thinking, he has generated billions of dollars of net worth for those who have entrusted him with their money. This constant process of allocating and reinvesting shareholder dollars is done with such ease and confidence that Buffett accepts a yearly salary of just $100,000. Judging by the way he lives, a salary of more than $100,000 would probably seem an insult. Buffett is fully capable of finding profitable opportunities on his own and has never needed the buttress of a bi-monthly payroll check. "I don't need 3 cars or 3 houses," he is wont to say. "That's just more things to take care of. I can't drive more than 1 car at a time, anyway." Every description of Warren Buffett from friends, business associates, and shareholders carries the same tune, which is a remarkable testament to Buffett's mental, financial, and psychological constancy. He is, in essence, a grown-up version of the fun-loving but cautious boy who wore a metal money changer around his belt, memorized the populations of cities, and was his classmates' emotional and practical auditor. Writings from his youth during the 1950s bear an incredible resemblance to his annual reports of the late 1990s. No amount of economic and political change over 4 decades has amended his dry wit, logic, and ability to detoxify data like a scientist conducting a control experiment. Spend 5 minutes with Warren Buffett, and you might walk away unimpressed by his physical appearance and his ostensible shyness around strangers. Despite his worldly wise demeanor, Buffett has spent nearly all of his 70 years circulating within a 2-mile radius in central Omaha. Spend 20 minutes, enough time to let his synapses warm up, and you'll be treated to an encyclopedic recitation on topics ranging from college football to Coca-Cola's unit volume growth in Latin America, or the balance sheets of major banks. Those lucky enough to get a 20-minute audience keep coming back for more. Some 14,000 investors spend an average of $1,000 each to descend on Omaha each May to hear a day's worth of his witticisms. If time and consistency build loyalty, Warren Buffett is the best consumer brand in finance. Chapter 2. Buffett Math 101. The Power of Growth. The field of finance has evolved to the point that participants can analyze and solve virtually any problem. Thanks to advancements in mathematics made through the centuries, investors can reduce the task of personal finance to a series of logically derived equations. Indeed, a working knowledge of computation will take you a long way in finance. Mathematics is sterile, devoid of emotion or bias. Any time you can strip away irrationality from the oftentimes emotional realm of stock picking, your decisions and results will be that much better. Financial planners believe that upward of 80% of all dilemmas we face involving money can be solved with routine mathematics. Using nothing more than simple algebra, for example, a consumer can calculate whether it's better to lease or buy an automobile, whether refinancing a mortgage will save money, whether it's better to buy term or whole life insurance, whether it's better to owe taxes on April 15th or to claim a refund, whether a fixed-rate mortgage is better than one with a variable rate, whether it makes more sense to pay a minimum balance on a credit card or pay the entire balance at once, and whether it's better to invest money on your own or through a 401k payroll deduction plan. These decisions, along with hundreds of others you must make as a consumer, form a critical path to your long-term financial health. On the surface, the decisions might seem daunting, but they are all solvable within a few minutes. Successful investors such as Warren Buffett draw their inspiration from mathematics. But unlike so many other professional investors, Buffett doesn't believe in applied data mining. Anyone can juggle data and find ways to make an unsound investment appear safe or make an overvalued security appear cheap. It's deceptively easy, for example, to change a single assumption in an earnings forecast and turn a $25 stock into one worth $100 or more. Nevertheless, in its essence, investing is a process of simplicity. One needs to understand basic algebra at most to conquer stock picking. By using tools taught to most 8th and 9th graders, a novice investor can achieve high returns over long periods. If calculus were required, I'd have to go back to delivering papers, Buffett told an assembly of securities analysts in New York in 1994. Essentially, you're trying to figure out the value of a business. It's true that you have to divide by the number of shares outstanding, so division is required. If you were going out to buy a farm or apartment house or a dry cleaning establishment, I really don't think you'd have to take someone along to do calculus. Whether you made the right purchase or not would depend on the future earning ability of that enterprise, and then relating that to the price you were being asked for the asset. In investing, mathematics should not be the end, but rather the means. It should not consume your stock-picking methodology, Buffett believes, but should serve to reveal very logically whether a certain deal makes financial sense. Armed with some of the basic rules of finance, an investor can begin analyzing disparate securities with the same rigor as Buffett. If a project or buy or sell decision makes numerical sense, it should be carried out. If numbers don't justify the action, postpone the project for another day. The power of compounding. It goes without saying that to a person such as Warren Buffett, the power of compounding is paramount. No force exerts more influence on your portfolio than time. Time takes a bigger toll on your terminal wealth than do taxes, inflation, and poor stock picking combined. Time, you see, magnifies the effects of these critical issues. A poorly chosen stock may cost you only $2,000 in losses today, but over time that one suspect decision could cost $50,000 in lost opportunities. Trading frequently for short-term gains may net you strong gains periodically, but the overall result, validated by time, is to create an enormous tax burden that could have been avoided. Likewise, persistent inflation exacts a weighty toll on your portfolio because it destroys value at increasing rates. Means and end should not be confused, Buffett once wrote to his partners. The end is to come away with the largest after-tax rate of compound. There's the story that if the Indians wanted to buy back Manhattan, they would have had to pay more than $2.5 trillion by January 1, 2000. That's what the $24 sale price in 1626 would have compounded into at 7% annual rates. And the clock keeps ticking. Next year, Manhattan's theoretical value jumps by $175 billion, 7% of $2.5 trillion. The following year, another $187 billion is added. The year after that, $200 billion, and so on. Letting wealth accumulate and compound unfettered, and if possible untaxed, is a potent formula individuals should use to increase their standard of living. Let time work to your advantage. Choosing good companies at fair prices seldom has produced losses for investors willing to wait patiently for the stock price to track the growth of the company. Time is the friend of the good business, the enemy of the poor, Buffett has said many times. Strong enterprises see their intrinsic value rise consistently, lifting the stock every step of the way. Over a period of 5 years or more, there should be a very close correlation between the change in the value of the company and the change in the stock. Watching great companies increase their sales and earnings consistently is a dream come true for an investor. The power of compounding begins working its magic as the years progress and allows your net worth to gather momentum and increase in dollar value by greater and greater amounts. The mathematics of compounding excited Buffett in his earliest years, and stories abound of how he memorized compounding and annuity tables to help him calculate an investment's merit and to keep his personal portfolio on a straight upward track. Biographer Roger Lowenstein, for example, tells the story of how a 7-year-old Buffett took ill suddenly and was hospitalized close to death. Forced to lie still in a hospital bed, Buffett entertained himself and, it seems, the nurses by scribbling a page full of numbers that projected his future net worth year by year. Ignore Wall Street's predictions of performance. Most of the 20th century's great investors shared a common belief that the sky was their limit, so to speak. They refused to accept average performance and strove to find ways to outperform their peers. In retrospect, their tales of success should serve as inspirations for what can be attained in the investment world when you set your sights higher than those of the general population. They attained 20% annual returns because they tried to. One cannot attain such a level of success by luck or complacency. The market doesn't reward fools for long. For the better part of the 1990s, investors were told to expect 11% annual returns in the stock market. 7 decades of data, in fact, suggest that the market's long-term rate of return may be roughly this amount. To accept this benchmark is to put yourself on a course for mediocre performance. Too many investors fall prey to Wall Street statistics and craft stock-picking strategies and portfolios that nearly guarantee them market-tying returns at best. Some load their portfolios with too many stocks and, as a result, place statistical ceilings on their performance. Evidence shows that the more stocks one owns, the closer one's returns will mimic those of an index. Other investors limit their long-term returns by holding too many poor-performing stocks that offset the gains of their winners. Still others take excessive risks and pay high prices for their stocks. Such strategies work from time to time, but over long time periods, buying high ultimately weighs down your returns. Brokers, financial planners, accountants, and money managers have all tried to convince investors to expect 11% annual returns from the market. The 11% figure has been recited so many times through the years it has become hardened in the lexicon of the bull market. The 11% figure wasn't pulled from thin air. It has historical backing. This is the compounded annual return an investor would have called by buying a basket of large-cap stocks between 1926 and 1999. Because investors have little else to go on when trying to predict the direction of stocks, only a handful of the world's stock markets have operated continuously since the mid-1920s. They have had to rely almost exclusively on the 11% figure as their benchmark. But extrapolating stock price trends is inherently dangerous for many reasons. The stock market doesn't obey calendars and rarely behaves as predicted. Just before the last great bear market in 1973 and 1974, numerous articles claimed a new era had arrived, that stocks were destined to rise perpetually. Financial planners created glossy brochures showing how investors could compound their assets into a large retirement nest egg because of the market's tendency to rise consistently over time. Today, many arguments have been made to support the thesis that the market's long-term trend line has been breached. Economists argue that the improvement in productivity experienced by U.S. manufacturers may usher in a new era of profitability. Others contend that the economy is virtually immune from recession, and by inference, immune from the types of bear markets that mute historical averages. Indeed, many market strategists have been relying on a quantum jump in growth. They want you to believe that the market will continue to grow 11% a year from present levels, not from trend lines established decades ago. They are drawing new trend lines above and parallel to the old. It's a backdoor way of saying, the past is relevant, but only the good years. Unfortunately, the market does not obey formulas. There is no guarantee that the recent past will be replicated. Just because the U.S. stock market has risen at 11% annual rates for 70 years doesn't mean the next 70 years will be the same. Certainly, the past says nothing of what we can expect over the next few years. By relying on dubious statistics rather than focusing on companies and their performance, investors undermine their goals. They diversify too much, they demean the role of analysis, or they fail to monitor their portfolios properly. These three mistakes explain why most investors fail to achieve adequate returns. To lay the groundwork for successful investing, you must first ignore the marketing scripts. It is wrong and frequently risky to link past returns to the future. Just because the S&P 500 index has risen at 11% annual rates does not mean it will return 11% over the next several decades. It may return 5%, or it may return 20%. According to Buffett, the market may post negative returns over the next several years before resuming an upward course. The good news is that once investors reject the sales utterances of Wall Street, they are no longer bound by limitations when setting goals. Buffett tells investors that it's possible to obtain returns far in excess of the market, whether the market rises 10% a year, 2%, or 20%. The power of time works to the advantage of an investor who can keep ahead of the market. If you can obtain even minor improvements over the market's return, you will generate staggering long-term results due to compounding. Assuming the market rises 10% a year, an investor who begins with $10,000 and obtains 12% a year has 43% more money after 20 years than someone who merely kept pace with the market. After 30 years, the investor has earned 72% more money. The results explode when an investor can attain returns above 12%. By earning 14%, you would have 192% more money in 30 years. If an investor can attain 16%, he earns 391% more money by year 30. Compounding also works in the opposite direction. The punishment for lagging behind the market is as substantial as are the rewards of beating it. After 30 years of 8% yearly returns, a portfolio lags behind the S&P 500 by 73%. It takes just a few major mistakes to keep your portfolio from attaining truly outstanding returns. Holding on to a poor-performing stock too long can put you years behind your long-term goals. So can selling a strong-performing company too early. A portfolio that is too large will ensure that you never generate a return above 11%. Conversely, a portfolio that is too small, with just a handful of stocks, forces you to be nearly perfect in stock picking. One disastrous holding could keep you behind the market for years. The goal of trying to beat the market can prove to be quite worthy, Buffett noted in his 1988 annual report, because the long-term compounded returns of beating the market can be astounding. From 1926 through 1988, Buffett noted, the market provided a total return of 10% a year. That means $1,000 would have grown to $405,000 if all income had been reinvested. A 20% rate of return, however, would have produced $97 million. That strikes us as a statistically significant differential that might, conceivably, arouse one's curiosity. Chapter 3. Buffett Math 201. Enhancing Returns with Little Effort. The previous chapter showed two ways in which average investors could take advantage of simple mathematical principles to enhance their portfolio returns. First, I showed how the power of compounding, letting time work in your favor, helps you capture the best possible gains from your favorite stock holdings. Second, I outlined how you can magnify the effects of time by aiming for higher returns. Investors should never accept average returns because that's the best they will ever attain. They should instead seek ways to further their yearly returns. Adding a few extra percentage points of gain each year compounds into huge amounts over time. It is possible to earn 3 times as much money over a 30-year period by improving annual returns a mere 4 percentage points. Mathematicians and other academics like to believe that such prestidigitation is impossible to sustain over long periods. No investor, they argue, can consistently earn abnormal gains without taking undue risks or striking it lucky. Buffett and generations of value investors before him have scoffed at that notion. Not only is it possible to attain market-beating results, but it can be done without taking excessive risks. In this chapter, I discuss 3 more strategies, all crucial to Buffett's success, for enhancing your returns. The wondrous thing about these 3 methods is that they really don't entail much blood or sweat, or good stock picking for that matter, just a dose of rationality. Like dieting, where you attain your goal by doing nothing, you simply eat less, investors looking to pad their results can find solace in a few exercises that involve little or no effort. Step 1. The miraculous advantage of buying low. I recall vividly a phone conversation with an elderly client in 1999 concerning America Online, a stock he was all too eager to buy. "I finally decided to bite the bullet," he explained to me. "I've been wanting to buy America Online for a year, but it just kept going up." "Why did you buy it now if you thought it was too expensive at half the price?" I asked. "It looked like it was going to keep going up," he explained. "I need a good return on my money, and there are not many stocks offering that." Whatever happened to the dictum, buy low, sell high? These days, the manifesto seems to be, buy very high, hope to sell higher. I can appreciate the gentleman's desire for a high rate of return, but his strategy of giving in to the crowd is a fatal flaw that keeps most investors from maximizing the potential of their portfolio. Because high returns are the predominant goal of investing, it behooves individuals to gauge a stock's return potential before buying. Sadly, most investors place no hurdle rate on their stocks. They don't, for example, set a required return of 15% a year, or screen for stocks that can rise a minimum 50% in 2 years. They simply buy at prevailing prices, no questions asked, hoping the price keeps rising, even though history shows that the highest rates of return are earned when you buy near price bottoms, not tops. It is no coincidence that most of the great money managers of the 20th century, Buffett, Benjamin Graham, John Neff, Sir John Templeton, Philip Fisher, Lawrence Tisch, Walter Schloss, Philip Carre, and others, are value-oriented. Nearly all of them followed the investing game plan laid out in the 1930s by Graham, who taught hundreds of pupils over a 40-year period the merits of valuing companies and of buying stocks when the market underpriced the company. Buying a stock for $50 when the company was worth, say, $75 or more, Graham taught, was the latchkey that opened the doors to high returns. Almost by definition, an undervalued security must eventually rise in price, and an overvalued security must fall, Graham taught. The immutable laws of mathematics ultimately will bestow higher returns upon those stocks more apt to rise than fall. Intuitively, what Graham preached and what Buffett gleaned from Graham's teachings makes perfect sense. If you wish to enhance returns, you must buy at the lowest possible price. The lower the price paid, the higher your expected returns. If you wish to double your money on a stock such as Intel, you stand a better chance buying Intel at $75 rather than at $90 or $100. Similarly, an investor who bought Dell Computer at a split-adjusted price of $8 necessarily will boast a higher percentage gain than the investor who bought at $18 or $38. Where Buffett differed from Graham was in insisting that price be linked to growth and quality. It wasn't enough that a stock was undervalued, as Graham exhorted, for hundreds of cheap securities linger in the market every day. Buffett knew that the best returns would come from buying established growth companies, ones capable of growing faster than the market, but at reduced prices. Step 2. Keep it concentrated. It's rare these days to find an investor who is completely satisfied with his or her own portfolio. Some lament that they have made poor investment choices during the bull market and failed to keep pace with indexes. Many investors have criticized themselves for following a fad that went bust. Probably the most common problem I've encountered has to do with diversification. Few investors have developed any sort of strategy for blending and balancing stocks within their portfolios. At its worst manifestation, some investors have hoarded stocks like vases and own shares in dozens of companies. Some own more than a dozen mutual funds, several of which may hold the same types of stocks. They take diversification to the extreme to feel safe. However, diversification is the bane of high returns. A tiny percentage of professional investors have been able to cobble a market-beating track record over long periods by owning dozens of stocks. Among those who did, only a handful, such as Peter Lynch, could attribute their success to diligence and elegant stock picking. The rest are usually living off a few stocks that luckily delivered tremendous returns and kept the entire portfolio ahead of the market for years. A fund manager who obtains an 80% one-year return can live off that one period for several more years. Even if his performance lags in subsequent years, the 80% one-time return is usually enough to keep the portfolio above the Dow Industrials or S&P 500 for several years. Great value-oriented investors such as Warren Buffett and Philip Fisher have no use for diversification. They are keenly aware that diversification poses no long-term benefit to a portfolio and drags down potential returns. Diversification is a protection against ignorance, Buffett told investors at the 1996 annual meeting. The more stocks one owns, the more difficult it is to keep track of one's winners and losers and to keep a pulse on the financial performance of so many companies. Moreover, it gets exceedingly difficult to boost yearly returns above expectations. Step 3. Stay mindful of costs. Investors frequently ask how to enhance their portfolio's returns. The answer? Start by being cost-conscious. Most investors unwittingly throw away a small fortune over their stock-picking careers, paying too much for trades, trading too frequently, and making poor choices. When compounded over time, the money you burn on these activities can add up to several $100,000, if not $1 million or more. Before commissions were deregulated in 1975, most investors regularly paid their favorite broker several $100s per trade. Over time, this undesirable gratuity compounded into tens of thousands of dollars for high net worth investors, money that was no longer compounding for them. Remember, every dollar you invest or don't invest has an opportunity cost. Assume that you typically pay your broker $5,000 a year in commissions. Over a 20-year period, you will be giving your broker $100,000 and making him very happy, to be sure. But because of compounding, the money you paid in commissions actually could have been turned into $300,000 or more if left in your account. Let's assume that instead of paying a broker $5,000 a year, you paid him or her 5% on a $100,000 portfolio that grows 10% a year. In this case, you will hand $320,000 over to the broker over a 20-year period. Had you kept that money and paid zero commissions, the $320,000 would have grown to $706,000. Obviously, an investor can't eliminate commissions entirely, but you can come awfully close these days. Using deep discount brokers such as Brown & Company, which charges as little as $5 per trade for up to 5,000 shares, you can save yourself a couple $100,000 over the long term. Let's say that you make 20 trades a year at Brown & Company on a $100,000 portfolio that grows at 10%. After 20 years, you have given the broker just $2,000, the future value of which was just $6,400. Chapter 4. Maximizing Gains with a Buy and Hold Strategy. About 15 years ago, I visited a local carnival with a friend who lost about $200 playing a dice game. Watching him continue to plunk down $5 on each roll in the hopes of winning cash prizes of between $25 and $200, in retrospect, seemed pathetic. The odds were stacked heavily against him, although he never realized it. To win money, he had to roll 8 dice simultaneously and produce a sum near 45, or an average of 5.6 per die. The laws of probability dictated that a high percentage of my friend's rolls would yield a total of between 24 and 32, scores that coincidentally cost him $5 and forced him to roll again. The enthusiasm with which my friend embraced the game and to subsequent dejection reminds me of the market timing and day trading phenomena, which have become two of the great shams of the bull market. More than enough anecdotal evidence has surfaced the past few years to show that, contrary to investor-held fantasies spurred by more than a dozen best-selling books, short-term trading can't work consistently, and that most people who engage in the activity lose money. This evidence hasn't stopped countless investors from actively trading their portfolios in the hopes of quicker gains. In the early 1990s, investors held the average stock nearly 2 years before they sold it. By 1999, they were holding stocks for little more than 1 year. Buffett detests rapid trading. To him, it is a money-wasting activity that usually leads to inferior returns for investors. Further, it causes wide disparities in pricing that may prompt management to take unnatural or irrational actions to stem investors' biases. Consistently rational prices are produced by rational owners, he wrote in a special letter to shareholders in 1988. On a more holistic level, stock trading serves as a giant economic siphon that pulls money away from productive use and puts it into the pockets of the financial industry. Buffett once suggested, only half-jokingly, that the United States should adopt a 100% capital gains tax on the profits of stocks held less than 1 year. Most of our large positions are going to be held for many years, and the scorecard on our investment decisions will be provided by business results over that period, and not by prices on any given day, he told the Omaha World Herald more than 2 decades ago. Just as it would be foolish to focus unduly on short-term prospects when acquiring an entire company, we think it equally unsound to become mesmerized by the prospective near-term earnings when purchasing small pieces of a company. Certainly, many investors who casually buy and sell stocks online a few times a week may believe they are on the road to success, but their success is due only to the extraordinary persistence of the bull market, not to their own acumen. Since early 1998, the number of individual investors who flipped stocks as fast as hamburgers has grown to number in the tens of thousands. Lured by the fabulous success of Internet stocks and by the advent of online trading, many have concluded that it's a breeze to amass a small fortune by hitting a few keystrokes each day. Market analyst and investment manager Charles Ellis, in a now-famous formula published in 1975, virtually proved the dictum that the more often you trade, the worse your returns. The biggest factors causing weak returns, Ellis discovered, were commissions. The more you trade, the higher the commissions paid relative to your portfolio. As such, if you wished to beat the market, each trade must beat the market by several percentage points for you to keep pace. For example, if you wanted to beat the market by, say, 5 percentage points a year, and you expected the market to rise 10%, you would need a 15% return on your average investment, that is, if you traded in a vacuum. But since commissions and dealer spreads can average more than 2% of the value of each trade, your average return would need to be much higher, perhaps 18%. And if you held the average stock less than 1 year, a turnover rate in excess of 100%, your average return would have to be still higher. Investors with turnover rates in excess of 200%, Ellis concluded, could not hope to beat the market unless each trade, on average, beat an index by several percentage points. In 1998, finance professors Terence Odine and Brad Barber, then of the University of California, Davis, confirmed that frequent trading leads to inferior returns. Odine and Barber dissected the trading activity of 78,000 households over a 6-year period ending in December 1996. Interestingly, they discovered that the average investor picked stocks that kept pace with the S&P 500. During the 6-year period, the average household earned 17.7% a year, which was slightly ahead of the market's 6-year return of 17.1%. However, the net return, subtracting commissions and bid-ask spreads, was 15.6% a year, fully 1.5 percentage points behind the market. Yearly returns fell as trading activity picked up. Odine and Barber found that the 20% of households that traded the most, as measured by portfolio turnover, earned an average yearly net return of just 10.0%. Households trading the least obtained an average net return of 17.5%. In other words, investors were their own worst enemies. If they would have left their portfolios alone, they could have garnered yearly returns that would have been the envy of most mutual fund managers. Alas, in their pursuit of better gains, they committed countless unforced errors. The difference between a 10% yearly return and a 17% return is astounding when you compound results over a decade or two. The study's conclusion was that the cost and frequency of trading explained nearly all of the poor performance of households during that 6-year period. The research led to the conclusion that investors engage in excessive trading due to psychological factors, namely overconfidence. Investors seemed to attribute success mostly to their own stock-picking abilities, not to the bull market. They increasingly believed they could dart in and out of stocks by perfectly timing tops and bottoms and repurchasing their favorite issues at a later date and still make a profit. But, as Ellis had shown 2 decades earlier, they unwittingly became their own anchor. Buffett manifests confidence quite differently. Comparing Buffett with the investors Odine and Barber studied is like comparing a habitual lottery player to one who shuns the game. The addict buys lottery tickets incessantly, believing, "This will be my lucky week," or because he believes he has invented the right system for picking numbers. The non-player refuses to buy tickets because he has enough self-confidence to know he can make more money elsewhere. He won't spend $5 a week on a ticket that offers a 1 in 7 million chance of winning $10 million. He knows better ways to earn $10 million that don't involve gambling. Buffett, in fact, is so confident in his stock-picking ability that he is wont to continue holding an investment perpetually. Rather than lull himself into believing he can win by continually darting in and out of the market, Buffett believes he can earn and retain more money picking a few choice companies and letting them grow over time. All you do is buy shares in a great business for less than the business is intrinsically worth, with managers of the highest integrity and ability. Then you hold those shares forever, he told a Forbes reporter in 1990. To make the point, Buffett's portfolio is concentrated in a small number of companies he has owned for years. He began accumulating stock in the Washington Post in the mid-1970s until he owned 1,869,000 shares. In 1985, he sold about 10% of his holdings, but has kept the remaining 1,727,765 to this day. He continues to hold all 96 million shares of Gillette bought in 1989. He originally bought a preferred stock that converted into 12 million shares. There have been 3 splits since. He vows never to sell his 200 million shares of Coca-Cola despite the recent slump in revenues and earnings. Buffett began studying and buying shares of Geico, government employees' insurance, at the age of 21. He reportedly made a nearly 50% gain on his first Geico investment in a single year. Later, when Wall Street believed Geico was on the verge of bankruptcy, Buffett began accumulating large stakes in the insurer. By 1983, he owned 6.8 million shares, which turned into more than 34 million shares, 51% of the company, by virtue of a 5-for-1 split. In August 1995, he announced he would buy the remaining 49% of Geico and bring the company under Berkshire's umbrella. Such patience has paid off. His $45 million investment in Geico in the 1970s became worth $2.4 billion, a 54-fold increase in 20 years, when Buffett announced he was buying the rest of the company. He has held shares in the Washington Post for 27 years, over which time his $10.6 million investment grew to $930 million by the end of 1999, an 86-fold increase. During a period in which Wall Street's brokerages alternately told investors numerous times to buy and sell the Washington Post, Buffett held on for the maximum gain. Buffett has not paid a dime of capital gains taxes on the Washington Post since he sold a portion of his position in 1985. Few investors can brag of attaining an 8,600% return on one investment because so few will hold a stock long enough to maximize the stock's potential. Even though the past few years have provided several stocks that surged 8,000% within a few years, such as Dell Computer, Qualcomm, or America Online, it's doubtful that many investors reaped the full gain. These stocks rallied so prodigiously because investors flipped them so rapidly. Turnover caused most of the gains. The majority of investors tripped themselves up playing the market's short-term lottery. Holding period determines likelihood of gain. A September 16, 1999 article in Barron's noted the improbability of any short-term oriented investor beating the market. If you make $125 on a trade and then shell out a $50 commission, you net just $75, the article said. But if you lose $125, you're really down $175 once the commission is added in. The magazine determined that a trader who tries to scalp 8-point gains, as many day traders do, needs to rack up 3 winning trades for each loser. That is, their success rate of picking winners must be 75% just to break even. This seems impossible on paper. Short term, the market is almost perfectly random and unpredictable. Just like a roulette wheel that poses an equal chance of showing red or black, there is a near equal probability that the next trade on a stock will be up or down 1/8 of a point. Over time, anyone playing this timing game will have a 50-50 chance of making money. Factor in commissions, and the odds turn against you drastically. Let's say you had a $100,000 portfolio and during a year's time made 100 purchases, half of which returned $500 and half of which lost $500. At year's end, you have no net gains. However, if each trade cost you $50 on both the buy and sell side, your portfolio has actually lost $10,000. You can't break even until 60% of your trades are winners. To earn 10% on your money, 70% of your trades must be winners. To earn 20% on your money, 80% of your trades must be winners. Is it possible to make money 70% or 80% of the time? Yes, but not by short-term trading. The data strongly confirms what one would expect. The longer one's holding period, the more chances an investor has of making money, regardless of how good that person is at picking stocks. For example, you stood a more than 80% chance of making money buying an S&P 500 stock during any period between 1989 and 1994 if you decided to hold the investment for 5 years. During some periods, your chances were in excess of 90%. What this means is that on any given day you chose to buy an S&P 500 stock. For this study, it didn't matter which day or which stock. Your odds of picking a winner were at least 8-1 and sometimes 9-1 in your favor. Certainly, the strength of the bull market helped increase your odds of gains. Your success rate will always be helped by a market that rises several consecutive years. However, your holding period was still predominantly successful. If you held stocks just 1 year, your odds of making money in general were still excellent, but were more random. You ran increased risks of picking losers depending on when you made the investment. A 5-year holding period generally led to success rates close to 90% no matter what time period you chose to invest. In contrast, a 1-year holding period led to average success rates closer to 70%. During certain market periods, your chances of picking a winner fell below 50% if you held the stock just 1 year. You had a better chance of losing money during that period. Returns were more random and significantly reduced as your holding period shortened. The average success rate for an investor with a 3-month holding period was just under 60%. Given these types of statistics, it's no wonder the day trading phenomenon seems to be losing its luster. Publicized cases of success aside, the real world of mathematics eventually catches up to all those who are consumed by the temptation of gains. People are learning all over again that dice are fun to play with, but that you'll never profit from rolling them over and over. Chapter 5. Avoiding the Chain Link of Errors. Economic analyst and author Peter Bernstein, in his distinguished 1996 book, Against the Gods, The Remarkable Story of Risk, reminds us that numbers play an imperious role in every important endeavor in which mankind partakes. Simple events such as taking a shower in the morning, brewing a cup of coffee, or turning on the furnace were impossible to perform until man devised uniform standards of weights and measures and spent centuries testing and validating laws of physics. Absent that type of mathematical certainty, we would live at the whims of fate. We could not measure, predict, or adapt to the weather, for example, without first understanding how to quantify its patterns. We could not prepare our favorite dinners without knowing proportions. We could not place bets on a horse without first creating some slide rule for distinguishing the performance of fillies. Likewise, we could not price a bar of soap, an automobile, a house, an insurance policy, and a share of Microsoft stock without first being able to quantify their economic costs and benefits. Without numbers, there are no odds and no probabilities, Bernstein wrote. Without odds and probabilities, the only way to deal with risk is to appeal to the gods and the fates. Without numbers, risk is wholly a matter of gut. The game of investment, in its bare-bones essence, is a game of probabilities. An investor needs to quantify risks, make mental calculations of potential return, stir up those assumptions in a pot, and produce a stock-picking strategy that works the majority of the time. Unwittingly, many professional investors trip themselves up by creating complex stock-picking systems that rely on dozens of variables. They may, for example, study a stock's price movements over a 5-year or 10-year period and track nuances in trading volume and daily volatility, Or they may attempt to dissect the U.S. economy in every detail, seeking relationships between variables that may help them predict an outcome. Tens of thousands of investors rely on computers to sort through mountains of data on profit margins, sales growth, or inventory buildups. Others find solace in competitive analysis. They try to compare one company's price history, profit margins, P/E ratios, or sales growth with the entire industries in an attempt to find the next great winners from among dozens of similarly priced stocks. We can't fault investors for wanting to quantify their suspicions. A key element of risk management is to reduce as much uncertainty from an equation as possible. For example, if an analysis of data shows that a company's sales tend to rise by 5% every time interest rates drop 0.25%, then you have removed some uncertainty from forecasting. Armed with such information, you stand a better chance of predicting the future course of sales and earnings than an investor who lacks those data. Too much analysis, however, inevitably leads to trouble. There comes a point at which stock-picking systems break down and prove futile because they are too complicated. Warren Buffett is keenly aware of the limitations of data and shuns most artifices routinely used by professional investors today. There is no computer in his Omaha office, nor does he profess to operate one very well. Buffett has told interviewers that he doesn't use a calculator and has no need to check stock quotes during the day. In fact, Berkshire Hathaway Vice Chairman Charlie Munger once acknowledged that he never saw Buffett perform rigorous calculations on any prospective stock purchase. Buffett hasn't hurt himself by shunning basic tools. His lack of resources has probably served him better than if he had operated Bloomberg terminals, Quotrons, or statistical software packages. Buffett knows all too well the mathematical trappings of complex systems. Faced with the opportunity of performing detailed analysis of information to help him compete with the world's money managers, he prefers to keep it simple. So should you. The chain rule: what an assembly line has in common with stock picking. Let's say you bought a machine for your factory that had 5 working parts, and each part had a 5% chance of failing over an 8-hour shift. Assume, too, that each part relied on the other parts. That is, a breakdown in one movable part caused the next one to fail as well. What is the expected failure rate of your machine over an 8-hour period? Is it 5%, the failure rate of every part? Not even close. Believe it or not, failure will occur almost 23% of the time. The machine would likely break down about once every 4.5 shifts. That rate seems improbably high, considering that all 5 parts operate smoothly 95 of every 100 shifts. The higher failure rate occurs because the components' failure rates are linked. The success and failure rates are multiplied with each other. In this case, the whole is worse than the sum of the parts. This mathematical principle is very important to design engineers and plant managers who oversee production lines or who develop new products. Their goals are to create a nearly flawless operating system from multiple components. These goals can be attained 2 ways. They must either engineer parts so precisely that each part's failure rate is infinitesimally small, or create backup systems that keep the process working if one part fails. Today's personal computers, for example, operate smoothly, despite having thousands of microscopic components, because each part has an insignificantly low failure rate. In contrast, jet airliners fail so rarely because they are designed with dozens of backup systems that maintain the entity should key components fail. Spacecraft such as the Space Shuttle rely on both features. They contain advanced circuitry and telemetry components that have extremely low failure rates. Space shuttles are also equipped with dozens of backup systems in case of failure. This principle of linked errors has very important meaning for investors. Because we rely on systems when we pick stocks, technical chart patterns, earnings forecasts, or discounted cash flow models, for example, we subject ourselves to the same mathematical problems that confront design engineers. First, we can overcomplicate things and, as a result, unwittingly become our own worst enemies. A stock-picking system behaves no differently from an auto assembly line. The more components you add to your investing model, that is, the more complicated you make your stock-picking system, the more often it will fail, pure and simple. Second, because the probability of errors multiplies as fast as you add more layers of detail to your analysis, you must learn to avoid relying on models that use numerous variables, especially models based on future forecasts. Extra care in thinking is not all good, but also introduces extra error. Charles Munger once said, "Most good things have undesired side effects, and thinking is no exception." Let's say that you were trying to predict how Microsoft stock might perform over the next year. It's a daunting task, even for experienced analysts and market strategists. Here are the variables you would want to consider. 1. Microsoft sales over the next 12 months. To calculate this, you must try to predict the level of software sales worldwide, all brands, and then try to predict Microsoft's market share. To calculate worldwide software sales, you might have to estimate the growth rate of national economies over the next year and predict corporate demand for PCs and networks. This necessitates that you take into account changes in interest rates worldwide in addition to currency fluctuations. Then you must estimate the average price Microsoft will charge for its software, assuming you can guess the mix of products it will sell, and how Microsoft will report the revenues on an accounting basis. 2. Microsoft's operating profit margins. To derive this, you must estimate Microsoft's inventory costs, its mix of fixed and variable costs over the next 12 months, and the level of administrative expense it plans to carry on its books. 3. Microsoft's non-operating expenses. You would have to calculate how much interest it will have to pay on its debt, if any. Also, you would need to determine how much interest income Microsoft could expect from its cash and bond holdings. 4. The number of shares outstanding. You will need to calculate shares outstanding to estimate earnings per share. To derive this figure, you'll need to estimate how many additional shares Microsoft might float to pay for acquisitions or grant to employees for profit-sharing plans. Further, you'll need to calculate how many outstanding stock options might be exercised during the year. As much labor as this requires, you're only halfway there. You must next predict how the stock market will behave over the next year. Will there be a bear market or a bull market? Will technology stocks decline or soar? If they are to soar, why? What P/E ratio will investors be willing to pay for Microsoft stock over the next year? Will it be higher or lower than the industry's average? Higher or lower than its own historical average? Why? Such a rigorous dialogue might seem futile to a lay investor, but this roughly describes the methods used by brokerage analysts to predict quarterly earnings, stock price movements, and larger market trends. No wonder their predictions are wrong nearly all of the time. By relying on so many variables to predict stock price performance, sales, market share, interest rates, currency rates, operating costs, shares outstanding, options, earnings per share, and the public's prevailing mood over stocks, analysts unwittingly expose themselves to the chain link of errors. As their models grow more complicated and detailed, the rate of failure increases. Let's suppose that each of these assumptions about sales, profit margins, market share, interest rates, shares outstanding, and so forth bore a 20% chance of being wrong, an 80% success rate. The analyst's final prediction about Microsoft's stock price would bear such a high failure rate that it would be practically worthless to rely on it. If the analysts used, say, 8 variables to predict Microsoft's stock price, the prediction would bear a success rate of 16.7%. That is, an 83.3% chance of being wrong. Because each variable was used to help predict other variables in the equation, the failure rates become linked and multiplied with each other, rendering the model useless. This is the chief reason value investors such as Warren Buffett have little use for market forecasts or extravagant stock-picking systems. Complicated systems can be fraught with high failure rates, as outlined in the Microsoft example. As investing tools, they come close to being worthless, or at the very least, unwieldy and impractical. When researching a company to buy, your goal is to minimize your chances of failure, not increase your failings. The investor who labors to predict Microsoft's near-term earnings and share price performance might just as well try to predict next month's weather patterns in Indonesia. There would be the same chances of success. What begins as a logical study of events would necessarily degenerate into a sequence of predictions, premised on each other, whose conclusions might bear no direct cause and effect relationship. One faulty forecast would beget another and another. In the end, the investor might not be any better off than if she had randomly selected Microsoft's fate out of a hat. Chapter 6. Hitting for a High Average. If you are at least 50 years old, you probably have vivid memories of Ted Williams, one of the greatest hitters in baseball history. His impact on the game, both as a player and as an inspiration to generations of hitters who followed, continues to this day. Williams combined power, 521 lifetime home runs, with patience — he received more walks than any batsman in his day — and control, a 344 lifetime average, as no player had ever done before. He had the intelligence of a lead-off hitter and the brawn of a power hitter, the patience of a bench warmer, and the bat control of a singles hitter. His contribution to the game was to reduce hitting to a mathematical exercise. Fittingly, his greatest legacy was a thesis on batting, the science of hitting, a book that attracted Warren Buffett's attention. Williams' basic thesis was that the strike zone could be carved into 77 mini-zones that pitted the abilities of the hitter against the pitcher. Williams knew, for example, that a high and inside strike pitted his weakness against the pitcher's strength. If he consistently swung at those pitches, his batting average would suffer. A low and outside pitch produced the same results, a success rate far below Williams' lifetime batting average. However, if Williams received a pitch in his optimum strength zone, he put all his muscle into it, knowing that he could consistently produce a higher batting average. In constructing a template for success, Williams outlined a pattern of patience. He realized that it was often better to take a pitch on the fringe of the strike zone rather than swing for a low average. A called strike was better than making an out. Buffett extends the same reasoning to stock picking. The stock market is like a major league pitcher who fires thousands of pitches a day, with each pitch representing a certain stock at a certain price. As the batter, you must decide which of the thousands of pitches to swing at and which you will let whiz by. What distinguishes you from a baseball player, however, is that you don't have to swing, ever. The game of investing doesn't force you to take the bat off your shoulder and swing, unlike the batter in the stadium. No one will call you out. As Buffett says, "In investments, there's no such thing as a called strike. You can stand there at the plate and the pitcher can throw the ball right down the middle, and if it's General Motors at $47 and you don't know enough to decide on General Motors at $47, you let it go right on by and no one's going to call a strike." The only way you can have a strike is to swing and miss. Professional money managers must swing at pitches whether or not they wish to. The pressures to perform force them to switch in and out of stocks hundreds of times each year as information changes. They must worry about beating the S&P 500, beating their peers, successfully predicting quarterly earnings for 100 to 200 companies, and dressing up their portfolios for their marketing staffs. You needn't. You have the luxury of letting thousands of pitches pass you by before you call a broker or use the internet and buy 100 shares of an attractive stock. You can study 1,000 stocks a month and pick only one if you like. You can walk away from Charles Schwab stock until the price falls to a level at which you're comfortable buying. Or you can switch gears and look at any of the other 10,000 stocks trading that day. The stock market doesn't compel you to act, although it may dearly tempt you. You'll never risk any cash by walking away from an investment you don't fully understand, whose price isn't attractive enough, and you'll improve your batting average in the process. Once you discover a stock to your liking, one the market has offered up at a ridiculously low price, swing for the fences. Buffett notes that great opportunities, the ones that get you a 900 batting average or better, truly are rare. You may find 24 such opportunities over a 20-year period. The number of good opportunities, those offering attractive enough batting averages, might be closer to 100. Poor opportunities number in the hundreds each day. In the same way that Ted Williams carved up home plate into high average and low average zones, you should consider creating a schematic that assesses your investing batting average. In this case, the goal is to swing only at pitches offering the highest probability of success. Your success rate will be a function of two chief factors: the quality of the company and whether or not the stock is attractively priced. Generally speaking, the higher the price paid or the lower the quality of company chosen, the lower your chances of success. Statistics show that your holding period will also have an impact on your batting average. When you are trying to time the market for a short period, at best you'll have a 50% chance of picking a winning stock, and that's only if the stock is attractively priced. Because day-to-day fluctuations in stocks tend to be random and unpredictable, it follows that you'll have a 50-50 chance of picking a winner if you intend to hold a stock only a short time. Factor in taxes, commissions, and dealer spreads, and your chances of success, that is, making money, decrease dramatically. You should avoid situations where your chances of success are even at best. Instead, concentrate on investments where you have high confidence in earning a profit. Just as Ted Williams looked for pitches in his 400 zone, you need to look for stocks offering a better than, say, 75% chance of success, a batting average of 750. How do you find such opportunities? As I'll show in subsequent chapters, success in the market is linked mostly to the price you pay. Buy a growth stock at an attractively low price with the intention of holding the stock indefinitely, and your chances of making money are excellent. In fact, during the 1990s, investors generally had a greater than 80% chance of making money if they were willing to hold their stocks for more than a few years. Success rates dropped quickly for investors who weren't willing to hold their stocks as long. Likewise, batting averages dropped as prices rose. Paying 15 times earnings for a good company produced a high batting average in the 1990s. Paying 30 times earnings for the same company reduced the batting average significantly. A 30-year plate appearance. Just how long should an investor keep the bat on his or her shoulder while waiting for that right pitch? To be frank, you have the luxury of waiting indefinitely, Buffett says. If the stock never reaches the right price, don't swing. In fact, you really don't have to swing. You can take a pass on any stock and look at 10,000 other companies if you wish and invest in any of those, but make sure that those pitches are delivered at the right price. Buffett has studied nearly every large U.S. company over the past 40 years, some of them many times, and feels comfortable waiting for each of them to reach the right price. He has likely made mental notes of the maximum price he will pay for each one, and can wait patiently, sometimes for years, before he swings the bat. Buffett's patience serves as a great check and balance to his portfolio. It affords him time to conduct due diligence and prevents him from acting emotionally. By setting his price and rate of return targets years in advance, Buffett systemizes his stock picking, making sure never to commit the types of unforced errors that plague most investors. In 1998, he bought 129 million ounces of silver at prices at about $5 an ounce. When asked why he made such an unconventional investment, Buffett remarked that he had studied the silver market for more than 30 years and that the price of silver finally seemed attractive to him. Indeed, after adjusting for inflation, silver had just hit a 650-year bottom when Buffett made his play. Silver traded near its cheapest price since the 100 Years' War between England and France. Talk about a long plate appearance. Buffett had his eye on Coca-Cola's stock for years before he finally began building positions in the late 1980s. One can only guess how long he had studied Capital Cities ABC or Walt Disney before he took the plunge. Buffett had owned both stocks before and sold them, but kept an eye on the companies for years. He watched Disney for 3 decades before he was satisfied with the price again. Put your favorite stocks in inventory. Buffett, like many other great investors, tends to be very discriminating. He avoids the temptation of buying a stock that seems alluring at the moment. Any stock can potentially be a value if the price is right, but Buffett doesn't allow himself to be fooled into buying stocks just because they are undervalued. Eventually, each of the 10,000 or so U.S. listed stocks, including the Qualcomms and Oracles of the world, will trade at an undervalued price, but only a small fraction of the 10,000 companies offer compelling long-term growth prospects. Most have poor fundamentals or an erratic growth history and should be shunned. Many others will provide periodic trading gains and then languish when the investment community tires of their story and seeks short-term profits elsewhere. As you hone your stock picking over time, you will eventually whittle down your short list of buy candidates to a few dozen. Then you can zero in on this list and purchase them one at a time as their prices fall to favorable levels. You should avoid the temptation of buying stocks simply because you have cash on hand, Buffett believes. More often than not, a heavy wallet invites mistakes. At the beginning of 1999, Buffett was holding more than $35 billion in cash and bonds in Berkshire Hathaway's investment portfolio. He was content to hold this great sum of money, which was equal to the total yearly output of dozens of smaller countries, indefinitely, until he found suitably priced companies to purchase. In contrast, most investors feel a psychological need to put their loose change to work almost immediately. Rather than patiently wait for their favorite stocks to decline, they purchase shares of lower quality companies without spending time to study their fundamental properties. Buffett avoids this trap by identifying all the stocks he wishes to own over the next several years and buys them one at a time, but only when they fall to an attractive price. If the stocks do not fall to his desired price immediately, he takes no action. He knows that the odds favor a decline in price sooner or later. In the interim, he will devote his attention to other desirable companies whose prices may already have fallen to appealing levels. To help you practice the taking strike method, you should keep a list of your prospective stock picks. The list should include the maximum price you would willingly pay for the company today. Post this list in a convenient place and check it periodically. The obvious advantage to warehousing stocks is that it forces you to be vigilant. Before buying, you must determine a reasonable value of the company, which means studying the enterprise. Putting some time into the valuation process will greatly decrease your chances of buying prematurely. Buying companies in this manner also allows you to build the portfolio you really want and prevents you from adding undesirable stocks simply because you have idle money. In addition, the method harnesses your impatience and, most important, ensures top performance because you will not overpay for any company. You should update your checklist periodically to make sure your target prices are reasonable. If a company's growth prospects dwindle, the original buying price you set may be too high. Conversely, if the company's fundamentals improve, the stock may not retreat to your buying level again. In such cases, you must reappraise the company to determine whether it is truly worth a higher share price. The point is, when you don't have to invest, don't feel you should invest. Once you attain confidence in your own stock picking, you'll naturally make fewer and fewer buy and sell decisions. Being a successful investor gives you the same luxury as having a 20-game lead over the second-place team in September. You can rest the bat on your shoulder and take strikes indefinitely because it won't change the outcome of the season. One can see why Buffett embraces the taking strikes concept. Mathematically, it limits errors and improves the odds of profiting. Buffett is keenly aware that investing is an exercise in probabilities. If you bat 600 in the market, that is, you choose winners 60% of the time, you'll do reasonably well with your portfolio. Increase your odds to 75% and you'll do exceptionally well. Boost your chances even further to 80% or more, and you'll enjoy astounding returns over time. Nothing increases your odds better than latching onto a good growth stock at a reasonable price. Taking strikes also builds patience and temperance. Patience builds diligence and reasoning. Diligence ultimately provides strong results. While waiting for the right pitch, you force yourself to study companies carefully before buying. Instead of impulsively spending $5,000 on America Online at an uncomfortable price, you can spend time researching the company, reading financial statements, and learning about its industry, its valuation, and business model. You should not buy until you are completely comfortable with the price of America Online stock and sufficiently knowledgeable about the company. The same holds for any company, be it Microsoft, an electric utility, John Deere, or a $1 biotechnology stock. Chapter 7. Valuing a Business. How much is a business really worth? The answer depends on how one frames the question. One buyer may be willing to pay $50,000 for a business, and another might be willing to spend $250,000. On Wall Street, the same subjectivity prevails. One buyer may be willing to pay $50 for a share of stock, and another might be willing to spend $150 for a share of the same company. Obviously, both investors can't be right, although both will probably insist they are. It's this subjective interplay of price and value that makes investing as much an art as a science. Even the most seasoned analysts and fund managers on Wall Street can differ widely in how to value, say, McDonald's, Microsoft, or Duke Energy. Some won't dare touch Microsoft at $100 a share. Others would think nothing of paying $150. Many wouldn't touch a money-losing internet company with a 10-mile pole. Others gleefully place price targets of $200 per share on the same company. Theoretically, disputes over value should be slight. If all investors relied on the same facts and looked at those facts objectively, their analyses should produce roughly similar values. Every asset possesses an inherent intrinsic value that reflects both the long-term earnings power of the enterprise and the risks of holding the investment over time. Intrinsic value is dynamic. A firm's value changes with fluctuations in interest rates, the U.S. dollar, corporate earnings and sales, debt levels, and the economy, to name just a few factors. But at any given point in time, an investor ought to be able to reasonably value a business given the information at hand. Whether or not your assessment of value proves correct will be based on the assumptions you used. But by taking into account all the pertinent factors, you can quickly determine whether a stock you wish to buy is worth the price. That's your main goal when buying, to narrow the dartboard of choices and reduce the chances of making an error. Don't expect to pinpoint a company's value to the penny. At best, you might be able to calculate a company's value to within 20% of the firm's underlying value. But if you can come within 20%, you will have considerably narrowed your chances of making a wrong decision, namely overpaying for the target stock. For centuries, valuing businesses for sale was completely subjective. Not until the 20th century could buyers amass enough data on a company and its industry to construct a reasonable estimate of value. Even then, they often lacked the analytical tools to make a sincere judgment. Forecasting methods weren't perfected until the early part of the 1900s. In 1938, John Burr Williams postulated that a company is worth no less and no more than what owners can take out of it in earnings. You can determine what a company is worth by calculating what it can earn over its eternal lifetime and adjusting earnings for inflation and the time value of money. If you estimate that Intel will earn $175 billion over its expected life, after adjusting for inflation and your risk tolerance, then you should be willing to pay up to $175 billion to acquire the whole company. If Intel had 1.75 billion shares outstanding, each share must reflect the appraised value of the whole and should sell for no more than $100. Similarly, if you reasonably estimate that Wells Fargo Bank can earn $50 billion in net income over its life, you should be willing to pay $50 billion to acquire all of its shares, no more and no less. That's Wells Fargo's intrinsic value, the fair price for a share of the company's forward earnings. If Wells Fargo had 400 million shares outstanding, then the intrinsic value of each share would be $125. That's the most an investor should want to pay for a piece of Wells Fargo. To appraise the investment value, it is necessary to estimate the future payments, Williams wrote. The annuity of payments, adjusted for changes in the value of money itself, may then be discounted at the pure interest rate demanded by the investor. To Williams, 4 concepts are vital to appraising a company. 1. You must see yourself as an owner of the business and appraise a public company as you would a private enterprise. 2. You must estimate the company's future earnings potential. 3. You must determine whether future earnings will be erratic or a steady annuity. 4. You must adjust the value of future earnings by the time value of your money. Why did Williams base his valuation model on earnings rather than on share price? Earnings are tangible. An owner can stuff the earnings into his pocket at the end of each year and reinvest them any way he sees fit. A stock's share price, in contrast, doesn't reflect a company's worth, although many academics would disagree. Stock prices reflect investors' shifting perceptions of worth. The market's perceptions can be greatly distorted by fear, greed, misinformation, panic, or unusual supply and demand disruptions at the stock exchange. Indeed, there is no guarantee that a stock will ever rise after you buy it. It may fall despite years of record sales and earnings. Similarly, stocks can rise dramatically even though a company's sales and earnings are in decline. Over the long term, a stock should rise at about the rate the business rises in value. Over the short term, anything is possible. An investor must appraise a publicly traded company by the profits it can put in the owner's pocket. Movements in stock prices don't cause the intrinsic value of a business to fluctuate. They are the effect of what people perceive to be changes in intrinsic value. It's a mistake investors make every day in the market. Seeing a stock as an ownership interest is the first step toward valuing the enterprise. Benjamin Graham taught Buffett to see stock quotes in this context. Rather than accept the market's latest quote, Graham wrote in 1934, you must ask yourself whether the value being attached to the company's stock is a proper one. It is an almost unbelievable fact that Wall Street never asks, how much is the business selling for? Yet this should be the first question in considering a stock purchase. If a businessman were offered a 5% interest in some concern for $10,000, his first mental process would be to multiply the asked price of $20 and thus establish a proposed value of $200,000 for the entire undertaking. The rest of his calculation would turn about the question whether the business was a good buy at $200,000. Graham's approach rests on a simple supposition. You, as an investor, own the earnings. Your judgments of value must rest, first and foremost, on what the business can return to you in the form of yearly net income, not on what the market says the shares are worth. The market price merely gives you a point of reference that allows you to determine whether the company is undervalued, correctly valued, or not worth its present price. Estimating earnings. In determining what to pay for a stock, Warren Buffett must first place some sort of value on the firm. Without taking this first deliberate step, no investor, even Buffett, could determine whether the price paid was too high or too low. Lacking that information, neither Buffett nor you could determine whether or not the stock can deliver a good return, because returns are linked inextricably to price, and price must be linked to value. Recall that a firm's intrinsic value is simply the sum total of its future expected earnings, with each year's earnings discounted by the time value of money. Admittedly, this is the most difficult aspect to valuing a business. The best analysts on Wall Street, operating off million-dollar research budgets, have completely misjudged companies and entire industries on occasion. This is one reason why Warren Buffett loves companies that exhibit certainty. He can avoid the trap of trying to forecast the unknown, or clearing 7-foot hurdles, as he calls it. Charlie Munger and I have not learned how to solve difficult business problems. What we have learned is to avoid them, he says. To the extent that we have been successful, it is because we concentrated on identifying 1-foot hurdles that we could step over, rather than because we acquired any ability to clear 7-footers. Companies such as American Express, Wells Fargo, Gillette, and Coca-Cola have exhibited such steady earnings growth over long periods that Buffett can make quick, rational assumptions about their futures. Stability is an important determinant in valuing an enterprise. The more unstable a company's record, the more unstable will be its future. It follows that the company will bear higher risk and not be worth as much as a company exhibiting consistency. Unfortunately, 99% of the world's companies lack the consistency of an American Express. Lacking a stable track record from which to extrapolate, investors are often forced to make spurious assumptions about the future. Where Buffett differs from other business analysts is that he assumes, correctly, that standards of valuation are universal. He is not swayed by new era preachings that claim that technology businesses deserve to be treated differently or more leniently because of their novelty. All businesses must be judged ultimately by how they can convert sales to earnings and the annual rate at which they can increase earnings. An internet company can be and should be valued by using the same yardsticks as a railroad, an electric utility, a software developer, a filmmaker, or a retailer. All of these enterprises are worth no more and no less than the present value of their expected earnings. If they are not expected to earn money sometime in the future, Buffett says, they have no value. So valued, all businesses, from manufacturers of buggy whips to operators of cellular telephones, become economic equals. Intelligent investing is not complex, though that is far from saying that it is easy. What an investor needs is the ability to correctly evaluate selected businesses. Note the word selected. You don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Your goal as an investor should simply be to purchase at a rational price a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you will find only a few companies that meet these standards, so when you see one that qualifies, you should buy a meaningful amount of stock. You must also resist the temptation to stray from your guidelines. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. When estimating future earnings, investors should look first to the past. Research has shown that a company's growth record is, in most cases, the most reliable predictor of its future course. That notion holds whether you were studying a steadily growing company such as Merck or a highly leveraged cyclical mining company such as Inco. A company that has attained annual earnings growth of 15% in the past 25 years is not likely to post future results that deviate far from that level. That it could attain such a growth streak through recessions, wars, high interest rate environments, and market crashes is testament to the company's ability to sustain itself going forward. Discounting earnings for risk. The purpose of identifying and estimating earnings is to determine the level of business risk present. The more risky a company's earnings, that is, the more unpredictable they are, the less you should pay for the enterprise, holding other factors equal. A company's intrinsic value is inextricably linked to its operating consistency. A highly cyclical company with a history of fluctuating earnings does not appeal to Buffett as a long-term investment because it is so hard to value. The level of business risk is crucial to Buffett and to any appraiser because it ultimately determines the price you should be willing to pay for a stock. Once you determine a proper growth rate for the company's earnings, you must apply a discounting factor that compensates you for the time value of your money. For example, a certificate of deposit earns 5% a year, but its real return, adjusted for inflation, is less. A 10-year AAA corporate bond may earn 6.5%, but when you adjust for inflation, default, and business risk, the real return is less. The same applies to common stocks, only in this case the risk you bear is an opportunity cost. That is, what you gave up in returns elsewhere to buy this one stock. To Buffett, valuing a company is no different than valuing a bond. When appraising a bond, you calculate each year's income stream, or coupon, and discount each year's income by a rate that fully reflects all the risks and opportunity costs inherent in owning the instrument. The same applies to a business, except that the coupon is the company's yearly cash flow or earnings. Because you, as a shareholder, have a claim on the company's earnings, just like a bond investor has a claim on the coupon, it follows that your valuation should be based on the stream of yearly coupons you expect from the company. Opportunity costs represent what you could have earned on your money in a similar investment bearing the same risk. For example, say you had the opportunity to invest in a laundromat that offered a potential 15% yearly return, or you could buy shares of a railroad stock selling for $50. Both ventures carry equal risk. To determine the value of the railroad, you must estimate its future yearly earnings or cash flows and discount them by 15% each year. If the result yields a value greater than $50 per share, you should invest in the railroad. If you arrive at a value of less than $50 per share, the stock is overvalued and the laundromat offers the better investment. To discount earnings, you divide each future year's earnings or cash flow by your chosen discount rate. What is the appropriate discount rate? Academics argue ceaselessly on this point. Valuation specialists have been known to apply discount rates as low as 3% to companies, which can yield a very high valuation, or as high as 25% to the same types of companies, which makes most stocks seem overvalued, depending on how they interpret their data. Because choosing a discount rate is the most critical step to valuation and the step most prone to errors in judgment, Buffett opts for the easiest solution. He discounts earnings at the same rate offered by long-term Treasury bonds, preferably 10-year instruments. This makes rational sense for 3 reasons. 1. Buffett views all stock investments in the context of bond yields. If he cannot obtain a potential rate of return on a stock that can beat a bond's yield, he will opt to buy bonds. Thus, his first screen method of appraising a company is to set a hurdle rate that meets or exceeds that of government bond yields. 2. Buffett doesn't have to waste his efforts trying to determine an appropriate, unique discount rate for every stock he studies. Discount rates are dynamic and change constantly based on shifts in interest rates, earnings estimates, stock volatility, and the company's financial structure. An appraisal of, say, Sears Roebuck is relevant to the moment it is done. 2 days later, it's possible that new information forces an analyst to change the discount rate and appraise the company differently. To avoid having to adapt his model constantly, Buffett keeps his appraisal parameters rather rigid. 3. Discount rates used by most money managers don't adequately define volatility, and their models produce results that don't accurately measure the company's standing. To derive a discount rate, academics suggest that investors take into account the fluctuations of the company's stock as a proxy for risk. Higher volatility translates into higher risk and requires you to use a higher discount rate. Buffett defines risk differently. He focuses on business risk, that is, the predictability of the company's yearly earnings coupons. A cyclical company such as DuPont, with highly variant yearly earnings, bears much higher risk and deserves a higher discount rate than a company such as Walgreens, whose earnings have been growing at 12 to 14% annual rates for years. If a company possesses no business risk, that is, its yearly earnings are totally predictable, it is no more risky in Buffett's eyes than a government bond and deserves the same low discount rate. By focusing first on companies showing little variation in their earnings growth rates, Buffett can justify discounting earnings at Treasury bond rates. Risk comes from not knowing what you're doing, he says. The chief paradox of valuation, especially for high-growth companies, is that it relies on the unreliable. To derive a value in the present tense, one must be able to predict the future, or at least develop reasonable conclusions about a company's growth prospects. If you cannot predict how much money a company can earn 3 years, 5 years, or even 10 years down the road, your analysis will be fatally flawed. More than likely, you'll overestimate future growth and value the company too richly. Therein lies the problem, Buffett believes. Soaring valuations become self-fulfilling prophecies as investors come to believe that their favorite stocks can continue to accelerate their earnings, or post a track record of growth that runs contrary to its own history. The only way to justify high earnings multiples in growth stocks is by assuming that these companies' future track records of performance will be rosy, perhaps even rosier than in the past. However, the future is the least reliable determinant of value. To pay 100 times earnings for a stock such as Oracle, one must prove that it is worth 100 times its earnings. Oracle's past growth rate alone couldn't justify such a price. That leaves the investor the unenviable task of showing that Oracle's future earnings stream is worthy of a P/E of 100. Price-to-earnings ratios that high can be justified only if Oracle's sales and earnings grow at perhaps 30 to 40% a year for the next 10 to 15 years. What is the probability of that occurring? First, few companies in history have been able to grow at such outstanding rates for such a long period. Second, a company's future prospects are nebulous at best and almost impossible to predict with much certainty. Therefore, one must assign a low level of certainty to any predictions made about Oracle. Indeed, as stock prices shot higher and higher in the late 1990s, analysts routinely avoided valuing companies in their research reports. They simply couldn't justify current prices with the types of analysis postulated by John Burr Williams and now taught in nearly every business school. Those who attempted to value high-growth companies were forced to assume that these companies could attain an ever-increasing market share and could post accelerating earnings growth. Most analysts resorted to nonsensical methods to justify their buy recommendations. If a company exceeded its quarterly earnings estimate, it was a worthy purchase, no matter how high the price. Likewise, high valuations were deemed practical, if only because a competitor traded at a similar valuation. Some companies were touted simply for their takeover premium, that is, what they could be worth if bought by another company. To value a company based solely on the future necessarily forces you to make a series of assumptions that may prove terribly wrong. Naturally, a company's intrinsic value is dynamic and constantly changes based on economic conditions, interest rates, debt levels, and changes in the marketplace. Intrinsic value changes from day to day for each company, but rarely at the rate at which a company's stock price fluctuates. A stock can rise from $50 to $100 in a 3-month period, even though the company's intrinsic value may adjust from $60 to $65. Likewise, a stock can fall from $20 to $5 at the same time that intrinsic value may rise from $5 to $6. Ultimately, price and value must walk in lockstep. Wide disparities between market price and company value cannot last indefinitely. If the market prices a stock at $100, even though the company is worth only $65, something must give. Either intrinsic value accelerates, or the stock plummets to $65 or less. As Buffett sees it, intrinsic value is elusive. Every asset possesses a true worth that can be discovered through rigorous analysis. Scrape away enough material from the surface and you can ferret out value, just as Michelangelo extracted life forms he believed were already embedded in blocks of marble. But pinpointing intrinsic value is exceedingly difficult, excruciating, and ultimately subjective. If it were easy, Wall Street's top analysts would all be in agreement on the price America Online should sell for, but such consensus almost never occurs. For every analyst or fund manager who calls America Online a bargain, you can find one, perhaps 10 analysts apt to sell their shares at the same price. Benjamin Graham circumvented this dilemma by insisting on a margin of safety. If you're not sure whether Wells Fargo is worth $80 a share or $100, give yourself a cushion. Wait until the price falls far below $80 before buying, just to be safe. Chapter 8. Book Value, Buffett's Favorite Yardstick of Growth. The first sentence of Warren Buffett's yearly letter to Berkshire Hathaway shareholders speaks volumes about what really matters to the 70-year-old CEO and investment manager. In it, Buffett recites his track record for the year just ended, using the company's growth in the balance sheet as his yardstick. Our gain in net worth during 1998 was $25.9 billion, which increased the per-share book value of both our Class A and Class B stock by 48.3%. Over the past 34 years, that is, since present management took over, per-share book value has grown from $19 to $37,801, a rate of 24.7% compounded annually. Buffett is keenly aware that book value growth is probably the most important ingredient in rewarding shareholders over time. A company that can continually increase per-share book value at high rates necessarily must also increase earnings at high rates. Therefore, it follows that an increase in book value over time must lead to proportionate increases in intrinsic value and share price. The percentage change in book value in any given year is likely to be reasonably close to that year's change in intrinsic value, he wrote to shareholders in 1996. Over long periods, in fact, there is a strong correlation between book value growth and share price growth. Companies such as U.S. Steel and General Motors have seen little tangible increase in per-share book value in the past 35 years. That's the chief reason their stocks have moved sideways for so long. General Motors stock traded in 1999 for just $20 above its 1965 peak price. USX trades lower today than it did in the 1950s. In contrast, Cisco Systems per-share book value increased at 91% annual rates in the 1990s. Not coincidentally, Cisco's share price increased at 92% annual rates over the same period. Oracle's share price and book value grew at collaborative rates of 33% and 31%, respectively, during the 1990s. Many other companies, Clear Channel Communications, Compaq Computer, Countrywide Credit, Nike, and Fannie Mae, experienced nearly identical annualized increases in book value and share price in the 1990s. A number of higher growth companies, Sun Microsystems, Microsoft, Intel, Amgen, Harley-Davidson, Dell Computer, and EMC, experienced share price growth far in excess of book value growth. If shareholders act rationally and are not prone to sell in a panic or buy during a frenzy, stock price movements should roughly approximate the growth in book value and intrinsic value. Historically, Berkshire Hathaway's stock has traded closer to the company's intrinsic value than perhaps 99% of U.S.-listed companies. Buffett keeps speculative activities in the stock to a minimum by refusing to split the shares and by issuing annual reports that provide more than enough information for investors to value the company. Moreover, he spurns Wall Street's quarterly earnings game and won't comment on interim earnings or give guidance to analysts. If we do that, we're on a different merry-go-round that caters to short-term investors. Shareholders choose us. We've never told anyone to buy or sell Berkshire. Lacking cooperation from management, analysts don't bother trying to predict Berkshire's earnings, which helps keep momentum-oriented institutions from wanting to dart in and out of the stock. Speculative rallies and panic-driven sell-offs are quite rare for Berkshire stock, which is how Buffett wants it. We do not want to maximize the price at which Berkshire shares trade. We wish instead for them to trade in a narrow range centered at intrinsic business value, he told shareholders in 1988. Charlie and I are bothered as much by significant overvaluation as significant undervaluation. Both extremes will inevitably produce results for many shareholders that will differ sharply from Berkshire's business results. The relevant measure of performance, Buffett believes, is the company's growth in per-share book value. When assessing his own year-to-year performance as CEO, Buffett compares the growth of Berkshire Hathaway's book value during the year to the gains of the S&P 500 index. If Berkshire's book value grows faster than the stock index, Buffett has done a better job than the index of delivering value to shareholders. And because book value is tangible, not fleeting like a stock price, it is the better barometer of performance. A stock can decline 30% in a month for little reason. A company's book value cannot, unless management takes drastic steps to restructure operations or has caused a huge accounting loss. How to grow book value. Buffett's book value scorecard clearly ranks him among the top CEOs of the 20th century. Since he took control of Berkshire Hathaway in 1965, the company's per-share book value has grown from $19 to $37,987, a 24% compounded annual increase. No other public company attained such a growth record over that same period. How did Buffett do it? He owes much of the growth to the rising value of Berkshire's stock holdings, which are carried on its balance sheet at their current market value. By carefully selecting growth companies for Berkshire's portfolio and buying them at a sincere price, Buffett helped ensure the rapid growth in the company's intrinsic value and share price. If the Coca-Cola stock Buffett holds rises $500 million in value, Berkshire's book value rises by $500 million as well. These days, it takes just a $2.50 per share gain in Coca-Cola to add $500 million in value. A $500 million decline causes the opposite effect. Every $1 increase in Gillette's common stock causes a $96 million increase in Berkshire's book value. Berkshire owns 96 million shares. The rise in Coke stock since Buffett bought it in the 1980s has caused Berkshire's book value to rise by $10.3 billion, or nearly $6,800 per Class A share. Berkshire's holdings of the Washington Post have increased the company's book value by more than $900 million, or nearly $600 per share. The 20-year rally in Geico stock added $2.4 billion to Berkshire's book value, and likely more since Berkshire took Geico private in 1996. Because few companies have the latitude or the legal ability to stuff their balance sheets with common stocks as Berkshire Hathaway has, they must increase book value the old-fashioned way, by expanding their profits, generating high returns on assets, and carefully acquiring companies that add economic value. When book value legitimately increases for these reasons, management increases intrinsic value and causes the stock price to rise. When earnings growth does not lead to growth in book value, something is amiss, as the following examples will show. Similarly, managers can take actions to raise book value in ways that don't lead to an increase in earnings and intrinsic value. When comparing a company's growth record, be mindful of the following facts. A company can increase book value simply by issuing more shares. Internet companies have been notorious the past few years for issuing tens of millions of new shares to stave off bankruptcy. The money raised from these offerings has been used to pay bills and to expand their markets. Each new round of financing injects huge amounts of money into the balance sheet, giving the appearance that these companies have substantial net worth. In reality, many are still bleeding red ink because their business models are not profitable. Companies can fabricate constantly higher book values by acquiring other companies. Management consultant Peter Drucker once said, "Deal-making is romantic and sexy. That's why you have deals that make no sense." It's entirely possible, in fact, likely these days, that an acquisition adds to book value immediately, but detracts from a company's earnings progress and impedes its intrinsic value. Usually, this is the result of the acquiring companies paying too much for the target and not getting $1 in value for every $1 spent on the transaction. Unfortunately, the results of poorly arranged deals may not be evident for a few years, when management may be forced to take asset write-downs or sell the acquired entity at a loss. When the acquiring company's share price sells at a large premium to book value, as most do today, it can substantially increase book value by issuing shares to pay for the acquisition. Book value would increase even though no real intrinsic value is created at the outset. Book value can be increased simply by letting profits sit in the bank, drawing interest. If a company stuffs its yearly profits in a savings account paying 5% interest, its book value will continue to rise each year, holding other factors constant. Yet, is management adding value by doing so? Interest income will certainly rise by larger dollar amounts each year due to compounding, and book value will grow each year at decreasing rates, but return on equity will slowly fall until it reaches 5%, and intrinsic value will grow at slowing rates. Book value paints a better picture than earnings. Why does Buffett focus on book value as a yardstick of performance rather than on earnings or stock price? Buffett doesn't rely on stock price movements because they are so fickle. He tells investors never to measure a CEO's performance based on how much the stock has gained from year to year. Over long periods, a stock will move in tandem with the company's performance. In the short term, there may be no correlation between the two. Buffett dwells on book value because earnings are pliable. A CEO can manipulate them in dozens of ways that inflate a company's bottom line for several years. Using restructuring charges, asset sales, write-offs, employee layoffs, or asset impairment charges, U.S. corporations can generously and legally cook their books and give the impression they are functioning on all cylinders when, in fact, they could be throwing their profits down the drain. Take, for example, the giant telephone companies such as AT&T, Bell South, Bell Atlantic, and SBC Communications. On paper, they posted gradually higher earnings almost every year during the 1990s. And investors, who were fixated on the bottom line, rewarded that performance with steadily rising stock prices. The three Baby Bell stocks, for example, quadrupled between 1986 and 1999. But these gains were mostly hollow because they were manufactured by frequent asset write-offs, restructuring charges, and layoffs. Each time AT&T or Bell South wrote off $1 billion for cost-cutting measures, they reduced their shareholders' equity by that same amount. AT&T took so many write-offs during the 1980s and early 1990s that the sum total of its accounting charges exceeded the earnings it reported. In other words, management created no real value. If you had happened to be the sole owner of these companies, Buffett points out, you could not have kept the profits for yourself, but would have had to reinvest the money every year just to maintain the business. If you have owned 100% of a great many capital-intensive businesses during the decade, retained earnings that were credited fully and with painstaking precision to you under standard accounting methods would have resulted in minor to zero economic value, he says. Those disgraceful accounting charges. Buffett is highly suspicious of accounting charges because they clear the deck of problems in one fell swoop and bury evidence of mismanagement that may persist for years longer. In his 1998 annual report to shareholders, Buffett labeled the growing use of accounting charges and write-offs a disgrace and accused CEOs of exploiting accounting rules to distort performance and prop their share price. A significant and growing number of otherwise high-grade managers have come to the view that it's okay to manipulate earnings to satisfy what they believe are Wall Street's desires. Indeed, many CEOs think this kind of manipulation is not only okay, but actually their duty. These managers start with the assumption, all too common, that their job at all times is to encourage the highest stock price possible, a premise with which we adamantly disagree. To pump the price, they strive admirably for operational excellence, but when operations don't produce the result hoped for, these CEOs resort to unadmirable accounting stratagems that either manufacture the desired earnings or set the stage for them in the future. Dozens of companies such as Motorola, Boeing, Nike, and several large banks significantly dressed up their 1999 earnings by taking billions of dollars of charges in previous quarters. S&P 500 companies took non-recurring charges equal to between 20 and 25% of their reported earnings in 1998. This was the highest level of accounting manipulation since 1991 to 1992, when many large companies were forced to take huge charges to write off the future costs of providing retirement benefits. Thus, for every $1 in per-share earnings these companies reported on their bottom line, upward of 25 cents may have been cooked. In contrast, charges against earnings accounted for much less than 10% of reported earnings for most of the 1990s. Motorola, in taking a nearly $2 billion charge in 1998, wiped out 13% of the book value it had built up for shareholders over several decades. Wall Street rewarded the behavior by pushing up Motorola's stock 200% over the next 15 months. Unfortunately, CEOs who use variations for these scoring schemes in real life tend to become addicted to the games they're playing. After all, it's easier to fiddle with the scorecard than to spend hours on the practice tee, and never muster the will to give them up, Buffett says. Nonetheless, it's highly likely the bad swings will keep occurring. When a company takes a restructuring charge, management all but acknowledges that it mismanaged corporate assets or tolerated a bloated cost structure, neither of which should be rewarded. Suffice it to say, investors should scrutinize accounting charges very carefully. Given that nearly every major industrial company announces at least one charge per year, it's becoming nearly impossible to judge accurately their bottom lines. Upward of 40% of quarterly earnings statements are manipulated and cannot be taken at face value because of previous charges, mergers, another major source of dubious accounting, says Buffett, and asset sales. Investors' tolerance of charges in the past few years seems to say a lot about our need for quick fixes. Market strategists adamantly defend today's stock prices on the presumption that corporate earnings can continue to grow strongly. However, if the earnings are false to begin with, this must eventually catch up to the bottom line, causing stock prices to land in the rough. Berkshire Hathaway has kept entirely clear of these practices, Buffett says. If we are to disappoint you, we would rather it be with our earnings than with our accounting. Chapter 9. Understanding Return on Equity. The 1990s truly were an extraordinary period for investors and corporate America alike. Not only were stock investors amply rewarded with gains averaging nearly 20% a year, but corporations displayed their best internal performance of the century. The two results, of course, went hand in hand. Had corporations not been so profitable and efficient, investors would not have been so willing to pay high premiums for their earnings. It's also doubtful that the stock market would have rallied by even a fraction of the amount it did. Indeed, some of the weakest market periods during the 20th century coincided with slowdowns in corporate earnings growth and dwindling returns on equity. Low returns on equity have tended to produce low stock valuations, and vice versa. As the decade closed, it was apparent that U.S. corporations deserved valuations above historical norms, simply because they generated returns on investors' capital far in excess of levels seen throughout the 20th century. The high returns on shareholders' equity, ROE, posted by the nation's largest companies in the 1990s were a major factor in the strong showing by the stock market. Those gains were made possible by some spectacular achievements: continued improved earnings, better internal productivity, a reduction of overhead costs, and strong top-line sales gains, to name just a few. The tools companies used to produce these results, restructurings, layoffs, share buybacks, and management success in utilizing assets, fueled one of the most impressive improvements in ROE in history. Returns on equity for the S&P 500 companies averaged between 10 and 15% for most of the 20th century, but rose sharply in the 1990s. By the end of the decade, corporate returns on equity jumped above 20%. That's a phenomenal rate, considering that the 20% level was an average of 500 companies. Many technology companies consistently posted ROEs in excess of 30% in the 1990s, as did many consumer products companies such as Coca-Cola and Philip Morris, and pharmaceutical companies such as Warner Lambert, Abbott Laboratories, and Merck. Because companies produced such elevated returns on their shareholders' equity, or book value, investors were willing to bid their stocks to huge premiums to book value. Whereas stocks tended to trade for between 1 and 2 times shareholders' equity throughout most of the century, they traded on average for more than 6 times shareholders' equity by late 1999. But even before 1999, Buffett began questioning whether corporations could continue to generate returns on equity in excess of 20%. If they couldn't, he said, stocks could not be worth as much as 6 times equity. History favored Buffett's assessment. American companies turned less charitable in the 1990s toward issuing dividends and retained an increasing share of their yearly earnings. In addition, the U.S. economy seemed capable of sustaining growth rates of just 3 to 4% each year. Under those conditions, it would be nearly impossible for corporations to continue generating 20% ROEs indefinitely. It would take yearly earnings growth in excess of 20% a year to produce 20% ROEs, an impossibility unless the economy were growing at rates far in excess of 10% a year. Returns on equity play an important role in analyzing companies and putting stock prices and valuation levels in proper context. Most investors tend to concentrate on a company's past and projected earnings growth. Even top analysts tend to fixate on bottom-line growth as a yardstick for success. However, a company's ability to produce high returns on owners' capital is equally as crucial to long-term growth. In some respects, ROE may be a more important gauge of performance because companies can resort to any number of mechanisms to distort their accounting earnings. Warren Buffett expressed this sentiment more than 20 years ago. The primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed, without undue leverage, accounting gimmickry, etc., and not the achievement of consistent gains in earnings per share. In our view, many businesses would be better understood by their shareholder owners as well as the general public if management and financial analysts modified the primary emphasis they place upon earnings per share and upon yearly changes in that figure. Return on equity. Return on equity is the ratio of yearly profits to the average equity needed to produce those profits. Buffett believes that companies that can generate and sustain high ROEs should be coveted because they are relatively rare. They should be purchased when their stocks trade at attractive levels relative to their earnings growth and ROEs, because it is extremely difficult for companies to maintain high ROEs as they increase in size. In fact, many of the largest, most prosperous U.S. companies, General Electric, Microsoft, Walmart, and Cisco Systems among them, have displayed steadily decreasing ROEs over the years by virtue of their size. These companies found it easy to earn enough profits to record a 30% ROE when shareholders' equity was only $1 billion. Today, it's excruciatingly difficult for them to maintain 30% ROEs when equity is, say, $10 billion or $20 billion. In general, for a company to maintain a constant ROE, it needs to exhibit earnings growth in excess of ROE. That is, it takes more than 25% earnings growth to maintain a 25% ROE. This applies for companies that don't pay dividends. Dividends reduce shareholders' equity and make it easier to post high ROEs. If management wishes to maintain a company's ROE at 25%, it must find ways to create more than $1 in shareholders' equity for every $1 of net income produced. The key to understanding ROEs, Buffett notes, is to make sure that management maximizes use of the extra resources given it. Any company can continue to produce ever larger earnings every year simply by depositing its income in the bank and letting it draw interest. If Microsoft shut down operations and reinvested yearly net income at 5% rates, earnings would continue growing, but ROE would plummet. By doing nothing, Microsoft's management could deliver 5% earnings growth for investors and brag of record earnings each year, but management would fail in its obligation to use corporate assets wisely. By 2010, Microsoft's ROE would fall to 10%. ROE would continue to fall for another 70 years until it reached 5% and parity with earnings growth. Indeed, when net income does not grow as fast as equity, management has not maximized use of the extra resources given it. Focusing on companies producing high ROEs, Buffett says, is a formula for success, because high ROEs must necessarily lead to strong earnings growth, a steady increase in shareholders' equity, a steady increase in the company's intrinsic value, and a steady increase in stock price. If Microsoft maintained a 30% ROE and the company never paid a dividend, its net income and shareholders' equity would rise at 35.4% annual rates. We also could expect the stock to rise at 35.4% annual rates over long periods. If the stock rose at the same rate that shareholders' equity increased, the stock would persistently trade at the same price-to-book value ratio. When evaluating two nearly identical companies, the one producing higher ROEs will almost always provide better returns for you over time. 5 other points are worth considering when evaluating ROEs. High returns on equity attained with little or no debt are better than similar returns attained with high debt. The more debt added to the balance sheet, the lower the company's shareholders' equity when holding other factors constant, because debt is subtracted from assets to calculate equity. Companies employing debt wisely can greatly improve ROE figures because net income is compared against a relatively small equity base. But higher debt is rarely desirable, particularly for a company with very cyclical earnings. High ROEs differ across industries. Drug and consumer products companies tend to possess higher than average debt levels and will tend to record higher ROEs. They can bear higher levels of debt because their sales are much more consistent and predictable than those of a cyclical manufacturer. Thus, they can safely use debt to expand rather than worry about having to meet interest payments during an economic slowdown. We can attribute the high ROEs of companies such as Philip Morris, PepsiCo, or Coca-Cola to the fact that debt typically equals 50% or more of equity. Stock buybacks can result in high ROEs. Companies can significantly manipulate ROEs through share buybacks and the granting of stock and options to employees. In the 1990s, dozens of top-notch companies bought back stock with the stated intention of improving earnings per share and ROEs. Schering-Plough, the pharmaceutical company, posted unusually high ROEs in excess of 50% during the late 1990s because it repurchased more than 150 million shares. Had Schering-Plough not been repurchasing stock, ROEs would have been between 20 and 30%. ROEs follow the business cycle and ebb and flow with yearly increases in earnings. If you see a cyclical company such as JCPenney or Modine Manufacturing posting high ROEs, beware. Those rates likely cannot be maintained and are probably the byproduct of a strong economy. Don't make the mistake of projecting future ROEs based on rates attained during economic peaks. Beware of artificially inflated ROEs. Companies can significantly manipulate ROEs with restructuring charges, asset sales, or one-time gains. Any event that decreases the company's assets, such as a restructuring charge or the sale of a division, also decreases the dollar value of shareholders' equity, but gives an artificial boost to ROE. Companies that post high ROEs without relying on one-time gimmicks are truly rewarding shareholders. Use ROE to predict future performance. There is some correlation between the trend of a company's ROE and the trend of future earnings, a point Warren Buffett has made on numerous occasions. If yearly ROEs are climbing, earnings also should be rising. If the ROE trend is steady, chances are that the earnings trend will likewise be steady and much more predictable. By focusing on ROE, an investor can more confidently make assumptions about future earnings. If you can estimate a company's future ROEs, then you can estimate the growth in shareholders' equity from one year to the next. And if you can estimate the growth in shareholders' equity, you can reasonably forecast the level of earnings needed to produce each year's ending equity. Using the Microsoft example, we were able to project a 30% yearly ROE through 2010. That allowed us to estimate Microsoft's year-end equity, which allowed us to calculate the net income needed to produce those figures. Using some simple calculations, we showed that Microsoft's earnings would grow at 35.4% annual rates. Such assumptions rely, of course, on whether Microsoft can continue to produce 30% yearly ROEs. If the company's ROE falls short, you cannot expect 35.4% earnings growth. No company the size of Microsoft can continue to grow at 30% rates forever, a factor you must take into consideration when evaluating today's less established technology companies. Warren Buffett's portfolio of consumer products and consumer cyclical stocks shows his preference for high, consistent ROEs. Coca-Cola and Gillette, for example, have steadily posted yearly ROEs between 30 and 50%, an astonishing record for companies that have existed for decades. Nearly all the other public companies in which Buffett owns large stakes boast average yearly ROEs of 15% or better. By virtue of their high internal returns and lower-than-average capital needs, these companies have managed to generate high returns on shareholders' money year after year and post earnings growth of between 10 and 20%. Chapter 10. Buffett's Magic 15% Rule. Warren Buffett knows that when a company delivers consistent earnings growth of, say, 10% a year, one can also expect consistent share price growth. In fact, for many companies, there is a nearly 1-to-1 correlation between long-term growth of earnings and growth in stock price. Companies that have increased earnings by 12% a year over long periods have likely seen their share price grow at annual rates close to 12%. Put together a portfolio of companies whose aggregate earnings march upward over the years, and so also will the portfolio's market value, Buffett said in 1996. Whether you get exactly 12% or more or less than 12% depends on two factors: the ability of the company to maintain its consistency and the price you are willing to pay for that consistency. If the public grossly overprices a company's earnings stream, the rate of return you can expect will likely not exceed the growth in earnings. Consider what happened to Procter & Gamble in the 1970s. The stock traded for more than 50 times earnings before peaking in late 1972, although earnings were marching upward at only 12% annual rates. Procter & Gamble stock fell steadily during the next several years, despite the fact that earnings tripled. In essence, Procter & Gamble's P/E ratio contracted. By the early 1980s, Wall Street had hung such a low price tag on Procter & Gamble's earnings that its rate of return potential was unbelievably alluring. Procter & Gamble continued to produce stellar earnings during both bear and bull markets of the 1970s and 1980s, but the rate of return depended significantly on the price paid relative to earnings. Before Buffett buys shares of a company, he makes sure the stock is capable of returning at least 15% a year for him over a long period. 15% is the minimum return Buffett requires to compensate him for inflation, the inevitable taxes from the sale of the investment, and the risk that taxes and inflation will rise in the ensuing years. For example, if a stock you bought delivers a 10% annual return, you'll likely lose 2 to 4% to inflation. You may lose 31%, possibly more, of your gains to federal taxes. In addition, you need a return well in excess of long-term Treasury bonds to compensate you for the extra risk you take on by owning stocks rather than bonds. There's no disputing that getting 15% a year is possible if you buy the right companies at the right prices. Conversely, it's possible to buy into great businesses and get inferior returns because you chose the wrong price. It's possible, too, to enjoy extraordinary returns from good and poor businesses when buying at the right price. Most investors don't realize that price and returns are linked. The higher the price, the lower the rate of return potential, and vice versa. It's that simple. By late 1999, the rapid rise in stocks had severely diminished the long-term rate of return potential of many great companies. To determine whether a stock can get him 15%, Buffett tries to estimate where a stock might trade in 10 years based on its earnings growth rate and average P/E ratio, and compares it to today's price. If the future price plus expected dividends doesn't equate to a 15% annual return, Buffett is inclined to forget it. By applying Buffett's simple calculations, he would logically avoid most of today's popular stocks until they fell further in price. This exercise hammers home an important point. The price you pay determines your potential rate of return. You will always get a higher rate of return buying General Electric at $80 rather than $120. When Coca-Cola peaked at around $89 in the middle of 1998, it traded for more than 60 times its yearly earnings. At the time, Coke was trumpeted by most brokerages and leading fund families as a can't-miss growth company. The trouble was, no one bothered to peg Coke's stock price to future performance. Even if Coke sales didn't suffer, at a price of $89, the stock was destined, perhaps doomed, to provide negative returns to new investors. When Walt Disney peaked in 1999 at $43, the expected rate of return over a 10-year period was just 0.5% a year. Given Disney's expected earnings, the stock would have to trade for $11 to secure a good chance of delivering 15% a year. If you wanted more than 15%, you would have had to buy below $11. Drugstore chain Walgreens offered the same abysmal return when it peaked in 1999 at around $45, or 48 times its earnings. By applying the formula, Walgreens would have had to fall to $12 before it offered a high probability of delivering a 15% long-term return. At $45, however, there was a distinct chance that Walgreens would deliver almost no gain over the next decade. Gillette would have had to fall another $16 to $22 before it cleared Buffett's hurdle rate. American Express would have to be cut in half. The most predictable value destroyer among all the popular large-cap stocks was Charles Schwab, which, when it peaked at $52, after splitting 3-for-1, offered a nearly guaranteed negative return for new buyers. Given Schwab's presumed growth rates, an investor could not hope to get a long-term 15% return until the stock fell almost 80% to around $11 after the split. These figures are difficult to swallow, but nonetheless telling. When you buy a stock that has already rallied several hundred percentage points in recent years, the rate of return potential going forward can be pathetically poor. Nevertheless, many investors assume that past results can be duplicated. They keep buying stocks such as Dell Computer or Qualcomm, thinking they can rise 60-fold again over the next 5 years. Nothing reduces the rate of return potential more than overpaying for a good company. As Peter Lynch once said, "It's a real tragedy when you buy a stock that's overpriced, the company is a big success, and still you don't make any money." Chapter 11. Putting Growth in Context. Warren Buffett would be the first to admit that no one, including himself, can accurately pinpoint the value on a company. 50 different analysts, each studying the same data, could come up with 50 different valuations for an enterprise, even ones as predictable as Walgreen and Merck. Theoretically, their estimates should be reasonably close, but that rarely happens. A rigorous analysis of a company, for example, may involve more than 100 inputs and variables, many of which are based on the analyst's hunch or estimate. Changing one or two key assumptions, such as growth rate, market share, or interest rates, causes an abrupt change in value. Buffett recognizes this inherent weakness in valuation, and in its place substitutes a common-sense principle: you'll know value when you see it. At the 1996 annual meeting, he admitted that he rarely applies hardcore valuation techniques when researching stock ideas. If the value of the company doesn't just scream out at you, it's too close. Indeed, most investors have preconceived intuitive notions of value before they buy an asset. A home buyer, for example, may not be able to value exactly a 4,000-square-foot Georgian home in Beverly Hills, but at a price of $750,000, he knows it's a steal. Similarly, if American Airlines lowered the price of a round-trip ticket from New York to Paris to $199, you'd recognize the value immediately. Likewise, you may be indifferent to Nike's stock at $50 per share, but you know that it's a bargain at $25. Suffice it to say that by late 1999, Buffett could find few screaming values left. In his mind, Beverly Hills-like stocks were fully priced and offered subpar rate of return potential. Oftentimes, a little common sense will let you determine whether a stock is a screaming value or whether an outrageous price has robbed the stock of all future appeal. Textbooks tell us that a company cannot be worth more than what investors can take out of it in earnings. In other words, if a company is expected to earn a sum total of $10 billion in profits from here to eternity, after adjusting for inflation and risk, shareholders should be willing to pay $10 billion today to own all the stock. Thus, if Amazon.com stock sells for $25 billion in the marketplace, as it did in early 2000, investors are betting that the present value of Amazon's future earnings will be $25 billion or more. If Amazon's earnings stream proves to be far greater than $25 billion, Amazon will be a screaming value. If Amazon can never earn $25 billion, its stock is grossly inflated. The question to consider, then, is whether $25 billion is a reasonable number or whether it grossly inflates the company's true potential. By using valuation templates found on the Internet, such as Stock Evaluator, an intrinsic value calculator hosted by www.quicken.com, Investors can quickly assess whether the market's current valuation of a stock is on target or off base. Stock Evaluator spits out a hypothetical value of a company based on growth rate assumptions users can plug in when they visit the site. It provides an effective tool for finding out the maximum you should be willing to pay for a company, given the current level of interest rates, the company's past and future growth rates, and your rate of return criteria. An investor can use intrinsic value tools such as Stock Evaluator in two ways. First, the real value of these tools is that they can provide a reasonable price range for buying. If data indicates a company is worth $50 per share, you should probably avoid the shares if they currently trade at $100. Conversely, if the stock trades for $25, extra investigation is warranted. Second, you can use Stock Evaluator to spot-check the market's current valuations, especially for popular technology stocks. Because it is difficult to estimate a company's future growth rate, Stock Evaluator allows you to take an indirect approach. You can start with the current stock price and determine the long-term growth rates necessary to justify that price. In other words, rather than question whether a stock is worth, say, $100 per share, try to determine what growth rate is necessary to make the company worth $100. Welcome to the United States of Yahoo and Cisco. In February 2000, I screened 200 of the largest U.S. companies to determine whether the market was correctly assessing these entities' future prospects. Using a discount rate of 15%, I asked Stock Evaluator's computer to determine what perpetual growth rate was needed to justify these companies' stock prices. A few companies passed the test easily, indicating that they were worth at least the current value of their stock. Beleaguered tobacco maker Philip Morris, for example, would have to exhibit a meager 3% growth rate in earnings perpetually to justify its washed-out $21 share price. Philip Morris's earnings, by the way, had grown at 16% annual rates since the late 1950s. Therefore, the market was assuming that Philip Morris's historical growth rate would slow by more than 80%. The stock peaked at almost $57 in late 1998. In pushing the shares down to $21, the market was either correctly assessing Philip Morris's future or was selling shares in panic. Abbott Laboratories, the pharmaceutical and medical products company, would have to grow at 7% annual rates to justify its February 2000 price of $33. The stock slumped more than $20 at the end of 1999 over near-term concerns about its drug development pipeline. Like Philip Morris, Abbott had exhibited 16% growth rates during the 35 years leading up to 2000, more than twice the growth rate investors were estimating when they drove the stock to $33. Retailer J.C. Penney found itself in a similar pricing squeeze to begin the new millennium. Based on a price of $18 per share, the company would have to grow at modest 6% annual rates to justify its price. Since 1960, Penney's earnings had grown at compounded 9% rates. But these stocks were the exception rather than the norm. Prices for many of Wall Street's favorite stocks assumed growth rates beyond belief. The most grossly overvalued stock was Yahoo, the internet portal that traded for $360 in February 2000. At the time, Yahoo had about $600 million in sales, and the company was beginning to report quarterly profits, but the market was valuing its stock at $90 billion, almost twice the market's appraisal of Philip Morris. Assuming a 15% discount rate, Yahoo would have to increase its earnings at 63% yearly rates for the present value of earnings to equal $360 per share. That figure assumes that Yahoo will maintain the same number of shares outstanding perpetually. For argument's sake, assume that Yahoo will increase sales at a 63% annual rate, a reasonable assumption because corporate earnings growth tends to track sales growth over long periods. By 2020, Yahoo sales would be more than $10.3 trillion. Assuming the U.S. economy continued to grow at 3% rates after inflation, Yahoo's 2020 sales would constitute 64% of the U.S. economy. If memories from biology class serve me right, not even paramecia multiply at that sustained rate. Sounds far-fetched, doesn't it? But a buyer at $360 a share unwittingly placed his faith in Yahoo attaining $10 trillion in sales someday. Any level short of $10 trillion guaranteed that the stock would eventually lose money if an investor held it long enough. After all, as Buffett has pointed out, a stock cannot be worth more than the earnings it will generate for investors. At the height of folly, Berkshire Hathaway Vice Chairman Charlie Munger once said, "People will stretch their belief systems to justify virtually anything." In self-appraisals of prospects and talents, it is the norm, as Demosthenes predicted, for people to be ridiculously over-optimistic. Munger told an assemblage of investment professionals in 1998. For instance, a careful survey in Sweden showed that 90% of automobile drivers considered themselves above average, and people who were successfully selling something, as investment counselors do, make Swedish drivers sound like depressives. Virtually every investment expert's public assessment is that he is above average, no matter what is the evidence to the contrary. Cisco Systems emerged as the second most wildly appraised stock, according to Stock Evaluator. To justify its $124 share price, Cisco's earnings would have to grow at 39% rates year after year. Many investors must have thought a 39% growth rate was feasible, despite the fact that no entity in world history has ever attained such a feat. Mathematics reaffirms that Cisco could not keep up the pace of growth. If Cisco's sales grew at 39% rates, for example, the company would boast $8.8 trillion in revenues by 2020. This would imply that Cisco's output would constitute 55% of the U.S. economy in 20 years. Combined, the sales of Cisco and Yahoo would exceed total U.S. economic output by $3 trillion. Imagine an economy made up of just two companies. Stock Evaluator showed that investors were presuming that Qualcomm, the telecommunications equipment company, would increase earnings at 46.5% annual rates when its stock traded at $140 in early 2000, after adjusting for a 4-for-1 split. Interestingly, Qualcomm had lost about 30% of its value in the weeks before this chapter was completed, yet even at a reduced price, Qualcomm was no bargain. Using the same projections made for Yahoo and Cisco, we can see that the $140 price tag implied $8.1 trillion in sales by 2020, fully 51% of the U.S. economy. The price of Walmart implied that the retailer would grow to be 33% of the economy by 2020. Motorola's hefty $155 price tag implied $5 trillion in sales by 2020. General Electric would have to attain almost $3.1 trillion in sales by 2020 to reconcile its $136 share price. America Online would be 1/10 the size of the economy, as would Oracle. Walt Disney would have to grow at 22% annual rates and constitute 8% of the economy. Amazon.com needed $4.5 trillion in sales to ensure that its $75 price in early 2000 was worth it. Extended bull markets, you see, tend to obscure logic. Price and value become irrelevant, and investors increasingly chase momentum, thinking that everything must continue to rally at rates beyond reason. Put these numbers in perspective. If the growth rates uncovered by Stock Evaluator were correct, the U.S. economy would one day consist of just a handful of companies, with Cisco, Yahoo, and Qualcomm consuming the bulk of our economic output. Keep in mind that a great deal of their sales come from overseas. Throw in Microsoft, Motorola, Oracle, and Intel for good measure, and there would be no need for any other employer to exist. we could all work for one of 7 technology companies. If you believed in such a rosy future, you were buying these stocks in early 2000. Buffett didn't and kept his money at bay. On this issue, Benjamin Graham articulated it best. This concept of an indefinitely favorable future is dangerous even if it is true, because even if it is true, you can easily overvalue the security since you make it worth anything you want it to be worth. Beyond this, it is particularly dangerous too, because sometimes your ideas of the future turn out to be wrong. Then you have paid an awful lot for a future that isn't there. Your position then is pretty bad. Chapter 12. Coveting Moats. The Quest for Stability. During regular visits to local McDonald's restaurants, I made it a point to read quota sheets the company posts on the back wall for its employees. The sheets totaled the number of orders placed for the day and itemized the number of orders that came from walk-in customers or from the drive-through line. Over a year's time, I noticed that the numbers were remarkably consistent. With the exception of holidays or certain Sundays, roughly the same number of customers ate at these select franchises each and every day. Just as predictably, between 68 and 70% of each day's customers ordered their meals from the drive-through line. Consistency, you see, is the mother of capital gains. Before its dining concept began losing its appeal in 1998, Cracker Barrel Old Country Store posted one of the more outstanding growth streaks in restaurant history. Earnings and sales grew at 15 to 20% rates for more than a decade, and the stock rallied in tandem with the growth in earnings. Consistency played a key part in Cracker Barrel's success. The average Cracker Barrel restaurant turned its table more than 8 times a day, meaning that the average seat in each restaurant, there are usually 175 to 200 seats, was occupied by 8 different people over a 24-hour period. No other restaurant turned its tables that often. As a result, the typical Cracker Barrel store could boast sales of between $3 million and $4 million a year, more than a McDonald's franchise attains. As a private investment, Cracker Barrel's stores were a gold mine. Because the company could seemingly count on 8 table turns a day, no matter the location of the restaurant, new Cracker Barrel locations could attain returns on an investment of 30% a year or more. That is, for every $1 million invested by Cracker Barrel building a new store, it could expect at least $300,000 in operating profits every year. Warren Buffett craves consistency because consistency helps remove risk from a stock portfolio. Research has shown that a consistent track record of performance tends to result in consistent share price growth. A company with a long track record of stable performance is much more likely to have a stable stock price than a company whose growth streak is pockmarked with sharp gains and losses. Inconsistent business performance is the bane of all investors. A company whose earnings growth fluctuates wildly over time, such as General Motors, Alcoa, Schlumberger, or Sears, will produce a trading pattern that resembles a roller coaster. During periods of rapid earnings growth, these stocks will ascend rapidly. Sooner or later, however, the company can no longer maintain its growth streak, and investors flee in droves. What results is an up-and-down share price where rallies of a year or two are followed by prolonged periods of decline. These types of earnings fluctuations can sometimes produce no net results for investors over long periods. When Sears Roebuck stock fell back to around $30 at the end of 1999, it traded for roughly where it did in 1972. By late 1999, General Motors traded about $15 above where it did in 1972. The decline in Schlumberger's stock in early 1999 brought the price back to the level it reached in 1980. Because these companies were never able to increase earnings consistently, their share prices bounced up and down in a large trading range for 2 decades or more. Along the way, they periodically fooled investors into thinking that consistent growth was at hand. Buffett chooses companies with consistent track records so he can remove as much stock price risk from investing as possible. He knows that if a company can deliver, say, 15% earnings growth year after year, the stock price will not show the level of intra-year gyrations common to most other stocks. Occasionally, these stocks will rally above the company's intrinsic value, in which case Buffett is likely to continue holding. On occasions when these stocks fall sharply in price, Buffett may go into the market and purchase more shares. In general, he will maintain his investment in the stock until it becomes apparent that the company's ascending legacy of earnings has been broken. The classic case is Coca-Cola, which went public in 1919. We have had depressions, we have had wars, sugar prices have gone up and down, a million things have happened. How much more fruitful is it for us to think about whether the product is likely to sustain itself and its economics than to try to be questioning whether to jump in or out of the stock? Minimizing share price fluctuations is crucial to great investors such as Buffett. Fluctuations cause most investors to rethink their strategy. Most investors are prone to fixate on share price as the true measure of a company's success, but not on its income statements or balance sheet. To these investors, a rising price validates that the company is performing well. A declining price triggers the opposite reaction. The temptation is to sell a stock when it begins to decline or turn too volatile. Choosing stocks that won't exhibit much volatility removes the temptation to trade unnecessarily. A proven track record is one important way to attain consistency. By focusing on companies with long and illustrious records of increasing net worth and value for shareholders, Buffett has managed to insulate his portfolio from broad fluctuations in value. The few occasions in recent years in which Buffett was susceptible to abnormal price fluctuations occurred when investors bid Buffett stocks to unprecedented valuation levels. Coca-Cola traded at more than 60 times earnings at its 1998 peak, and Walt Disney and Gillette traded for more than 40 times earnings throughout 1998 and 1999. All three stocks, in retrospect, were destined, some say doomed, to give back a large portion of their previous gains and post inferior stock performance, but rarely has Buffett made the mistake of owning a company that simply did not perform to his or the market's expectations. A company's track record can take a stock only so far, however. The second, equally important way to remove stock price risk and avoid abnormal price fluctuations is to own companies whose future can be quantified and predicted with some degree of accuracy. Because stock prices reflect an enterprise's forward earnings more than past earnings, it's important for investors to fixate first on companies able to project and carry their consistency into the next decade and beyond. Understandably, chasing posterity creates a conundrum for investors. Very little can be said of the future. The majority of U.S. companies and industries, in fact, will undergo major transformations over the next 10 to 15 years. Investors don't know, for example, how the economy will perform going forward, whether interest rates will rise or fall, or whether the U.S. dollar will catapult higher or collapse. Moreover, we cannot predict how the pace of technological and productivity change will alter the business climate. Today's popular industries may wither away within 5 years. The very technology stocks that Wall Street praises today as no-brainers may find their technological advantages overshadowed by new yet unknown competition. The current pace of technological change and the pace of productivity improvements are outstripping investors' abilities to analyze that change. Investors who are not mindful of this sobering certainty will find themselves misled into poor choices. We think new technology is very beneficial from a societal standpoint. Our own emphasis is on trying to find businesses that are predictable in a general way as to where they'll be in 10 or 15 or 20 years. That means we look for businesses that in general aren't going to be susceptible to very much change. We view change as more of a threat investment-wise than an opportunity. That's quite contrary to the way most people are looking at equities right now. With a few exceptions, we do not get enthused about change as a way to make a lot of money. We're looking for the absence of change to protect ways that are already making a lot of money and allow them to make even more in the future. Older investors certainly can recall the mid-1980s when the hottest technology stocks were hardware and software companies such as Kpro, Corona Computers, Grid Systems, Mohawk Data Sciences, and Commodore. All were touted by the financial industry as surefire ways to play the almost certain boom in personal computing. All fizzled faster than a bottle of warm diet root beer. At their peaks, they traded at P/E ratios in excess of 100. By mid-1999, Warren Buffett came under intense criticism in the media for maintaining a stodgy posture and avoiding the high-flying NASDAQ stocks that had provided investors extraordinary gains the previous 2 years. His purposeful avoidance of technology stocks in particular was derided in financial magazines and on chat rooms. "When is he going to wake up and smell the roses?" one hedge fund manager told me over the phone. "He's got to get with the program because technology is the place to be." Internet chat rooms were equally harsh on Buffett's buying habits. "His days are over. He belongs in the previous century," said an anonymous posting on Yahoo. Buffett held his ground throughout, pointing out that although technology was consuming an ever larger slice of the American economy, the group still seemed to lack the predictability that prudent investors require. If a company's future cannot be predicted, Buffett said, it cannot be valued. If a company cannot be valued, there is no indisputable way of ensuring a positive return on one's investment. A company whose future is totally unpredictable may be worth $200 per share or just $2. No one will know until after the fact whether the stock's current price was on the mark or a grave error. "I'd probably take an internet company and ask students, 'How much is it worth?' And anybody that gave me an answer, I'd flunk," Buffett told shareholders in 1998. If the new paradigms on which today's stock prices are based eventually prove faulty, is there anything on which investors can truly rely? Yes, says Buffett. A number of companies have grown their core businesses for decades with few cyclical interruptions. Given the steadiness of their businesses, we can reasonably assume these companies will function similarly for the next several decades and continue to provide steady gains for investors. Coca-Cola has been in the same business, selling syrup, for more than 100 years. Its core strategy will likely never change. Close your eyes for a decade, and you would awake to find Coke doing the same thing it's doing now, only its sales and profits would likely be much greater. Let's say you were going away for 10 years and you wanted to make one investment and you know everything you know now and couldn't change it while you're gone. What would you think about? I would want to know certainty, where I knew the market was going to continue to grow, where I knew the leader was going to continue to be the leader, I mean worldwide, and where I knew that there would be big unit growth. I just don't know anything like Coke. One could say the same for Gillette, Anheuser-Busch, Johnson & Johnson, Harley-Davidson, Tootsie Roll Industries, Wendy's International, Automatic Data Processing, Genuine Parts, William Wrigley, and Hershey. Granted, these companies lack the sex appeal of Qualcomm, Global Crossing, and JDS Uniphase, three of the hottest stocks in 1999, but they continue to deliver the goods for shareholders year in and year out. It is also doubtful that investors will witness any strategic changes at companies such as McDonald's. If the quota sheets at the restaurants are an indication, investors can count on consistent rates of return on their investment. 5 years from now, odds are good that the same number of patrons will walk into a McDonald's restaurant every day and that a high percentage of them will use the drive-through window. In contrast, does any internet stock currently offer even a fraction of the consistency and cash-generating potential McDonald's does? Will any in the future? If not, why have internet stocks such as Yahoo been priced in the market at twice the value of McDonald's? Can anyone say with any certainty what Cisco Systems or Sun Microsystems will look like in 15 years? Will they be in the same lines of business, or will their business models change radically? If you can't envision these companies' futures, make sure you don't ever pay a price that anticipates that far ahead. Stock prices are supposed to reflect all the earnings a company can potentially generate for investors going forward. If earnings cannot be predicted with much certainty, investors have assumed too much share price risk. Companies trading at more than 100 times earnings today must be capable of generating 30 to 40% sales and earnings growth year after year, a mathematical impossibility. Investors sometimes extend their faith to extremes. We hope that our best investments are immutable, that their hot growth streak can continue forever. The truth is that few, very few companies ever enjoy such luxury. Even Microsoft's and Walmart's growth rates have slowed considerably in recent years, as will the growth rates of today's highly touted technology stocks. Some will experience slowing growth much earlier than others. Think back through the 1990s and you'll recall a lot of sure thing trends that fizzled out because investors wrongly assumed the good times would last. Oil stocks were supposed to provide great returns because of constantly increasing demand for crude. Waste hauling stocks were supposed to take advantage of a growing population and a critical shortage of landfill space. Microbrewers and golf club manufacturers were supposed to be wealth effect plays. Medical device stocks were supposed to rise indefinitely because of the growing worldwide need for health care. Health maintenance organization stocks were supposed to be a great way to play the shift into managed care. Wasn't Boston Chicken supposed to be the dominant restaurant for families? Boston Chicken declared bankruptcy in 1999, just 18 months after the stock peaked at around $40 per share. Weren't PC components manufacturers Iomega and Western Digital supposed to have shared in the phenomenal growth of computers? Both were eaten alive by pricing pressures no one predicted. It's not easy, Buffett says, for businesses to grow unimpeded. There are people that are looking at what you're doing every day and trying to figure out a way to do it better, underprice you, bring out a better product or whatever it may be. A few companies make it, but here in the U.S., after all of these decades and decades and decades of wonderful economic development, we still only have about 400 companies that have hit the profitability level that would be required of a company with a market cap of $3 billion. And yet some companies are getting $3 billion of market cap virtually the day they come out. You want to think about the math of all this. The media like to poke fun at Buffett for missing the surge in technology stocks. Forgotten among their excoriations is the fact that Buffett never seems to put his money into losing stocks such as Boston Chicken either. He may have missed the ascent of Microsoft and Intel, but he also avoided countless other technology companies such as Iomega and Western Digital that spent their potential as quickly as a 4th of July sparkler. Unfortunately, in the business world, sparklers greatly outnumber superstars. Blindly putting money into technology stocks is a surefire way to guarantee mediocre returns because few will attain the greatness of a Microsoft. Just ask all the investors in computer stocks in the 1980s. If you had purchased equal amounts of stock of all the computer hardware companies that traded in the mid-1980s, you would have barely broken even as the century ended. The gains in Apple Computer, Compaq, and a few others barely offset the oftentimes horrific losses sustained by the rest. Lacking any knowledge of the future, a mid-1980s investor had to pick and choose winners from a crowded field of sure things, and most lost. Chapter 13. Comparing Stocks to Bonds. Money manager and author Gerald Loeb once remarked that the worst way to combat inflation is to buy assets as a supposed hedge at an inflated price. If you haven't accurately priced in the risk of inflation or the possible loss of purchasing power, you can easily wind up with a great asset that generates negative returns. As an investor, you must strive for self-preservation. The investments you choose should, at the very least, compensate you for the natural depreciation of assets that occurs over time. In addition, investments should bear at least the same rate of return potential as similar assets of similar risk. This concept is vital to accumulating wealth. If your assets cannot keep pace with inflation or the natural rate of depreciation of assets, your standard of living will drop. It is imperative that you pick a portfolio of assets that can appreciate in value faster than their natural depreciation rate. Indeed, the chief economic reason humans invest is to preserve their net worth from the effects of inflation. It was long held that inflation aided investors because it gave companies the latitude to raise prices and report better profit margins, earnings, and returns on equity. Today, inflation is viewed as an antithetical force. It not only lowers the reported value of corporate earnings, but also makes stocks less attractive than other instruments, namely bonds, that are theoretically priced for inflation. Consider this analogy Warren Buffett wrote for Fortune magazine in 1977. The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislature. The inflation tax has a fantastic ability to simply consume capital. It makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Buffett views inflation as a mighty economic force that never can be eradicated. Inflation can lie dormant for years, as it did during the late 1990s, but it can never be tamed. As long as governments have the ability to infuse liquidity into an economy or to debase their own currencies, an investor must assume that politicians occasionally, acting in their own self-interests, will take fiscal steps that unwittingly lead to rising prices. Like virginity, a stable price level seems capable of maintenance, but not of restoration, Buffett once quipped. The effects this can have on stock prices are potent. The last surge in inflation in this country, in 1994, caused stocks to slump in price for several months. By the end of 1994, after 11 months of sideways trading, many investors had thrown in the towel and had moved their money into bonds. Stocks that a year earlier sold for 20 times earnings were now priced at 8 and 9 times earnings. Rising prices, coupled with Federal Reserve Board actions to raise interest rates, ultimately doomed the 1987 stock market, too. The proximate cause of the one-day 508-point plunge was an unexpectedly large trade deficit. Months before the crash, interest rates had begun rising, causing analysts to revise downward their valuations of common stocks. The prolonged bear market of the 1970s also had its roots in rising prices, which acted as an anchor to dozens of popular large-cap companies that had been bid up to prodigious multiples of their earnings. When inflation rises over an extended period and bond yields rise, P/E ratios of stocks tend to drop. When inflation falls, bond yields fall and stocks rise. This correlative relationship between stocks, inflation, and bonds is sacrosanct and should never be ignored. Over long periods, stock and bond prices tend to react similarly to the same economic information. The true relation between stocks and bonds lies in their coupons, the amount of yearly returns you can expect to take out of each investment. Bond investors are intimately familiar with the notion of coupon. It is the amount the issuing entity, a corporation or government, pledges to pay each year as a percentage of the bond's par value. If a company issues a bond with a $1,000 par value and a coupon yield of 6.5%, the company has pledged to pay bond owners $65 a year, 6.5% of $1,000, until the bond matures. No matter how many times or at what price the bond changes hands in subsequent years, the $65 yearly coupon remains fixed. The yearly coupon payment never fluctuates, so a bond's value will be determined by three predominant factors. 1. The expected rate of inflation over the remaining life of the bond. 2. The prevailing yield on government bonds maturing at the same time. And 3. The risk premium bondholders demand based on their perceptions of the entity's financial stability. If bond investors expect inflation to reach 4% a year, they won't purchase a bond until it reaches a price that guarantees a yield to maturity of at least 4%. Otherwise, they would lose purchasing power. Common stocks offer their own form of coupon, the yearly earnings generated by the company. Whatever profits the company generates each year are legally owed to its stockholders. In most cases, however, the company retains profits and reinvests them to generate, you hope, higher earnings in the future. Thus, just as a bond possesses a yield to maturity, a stock has an earnings yield, according to Buffett, that allows you to compare it to bonds. As such, your goal in picking stocks is the same as that of a bond investor, to find an investment whose yearly returns, or coupons, more than compensate for inflation. Beyond that, you want to find stocks offering earnings yields that can beat risk-free government bond yields. This ensures that you can beat inflation and be adequately compensated for the risk of holding an instrument whose coupon is not assured. A bond pays you a set rate every year, whereas a company's earnings can fluctuate greatly from year to year. If a 30-year Treasury bond yields 6%, a company earning a fixed profit of $1 per share each year needs to trade for $16.67 to yield the same 6%. Presuming the company possesses some risk, investors should theoretically wish to value the company at less than $16.67 per share, which creates a higher yield. At a price of $12, the $1 in earnings would represent an 8.33% yield. At $14, the earnings yield is 7.14%. This direct relation between earnings, government bond yields, and stock price should hold in perpetuity so long as the company can generate $1 per share on shareholders' behalf each year. If yields on government bonds rise, the yield on the stock should likewise rise. The stock must fall to keep the earnings yield at parity with bonds. If government bond yields fall, one would expect the stock to rise to keep the coupon yield in sync with bond yields. Stocks are bonds with less predictable coupons. Think of a stock as a bond substitute, Buffett says, a dynamic security that has the capability of providing you less or more income each year than it did the preceding year. Whereas a bond's yearly returns are known and can be plotted exactly to maturity, a company's returns can, at best, be guessed. If you must buy a stock, Buffett says, make sure that the company's earnings coupons 1. Can beat inflation, 2. Can beat government bond yields, which are priced to reflect inflation, 3. Can rise over time. The third point is perhaps the most important. You should strive to improve the rate of return on your original investment. You accomplish this by acquiring stock in companies whose earnings yields increase over time. When earnings increase, the return on your original investment the earnings yield increases. The stock price will ultimately track the growth in coupon earnings. For example, consider a company that earns $1 per share, trades at $20, and is growing at 25% annual rates. By 2010, the company's earnings are providing a 46.6% return on the original investment, which is far in excess of inflation and the coupon returns of bonds. A 5% bond bought in 2000 would still return 5% in 2010. If interest rates never changed over that period, the price of the bond might stay fixed. The stock, however, is likely to surge in value. If the market continued valuing this company at 20 times earnings, a reasonable assumption, the shares would sell for $186.20 in 2010, an 831% return on the original $20 investment. The yearly earnings also would grow by 831% over the same period. As impressive as this earnings stream seems, investors could enhance their returns further if one of two events occurred. 1. Earnings growth accelerated above 25%, or 2. The stock dropped below $20. Either scenario results in higher coupon returns over time. The company's long-term returns would beat inflation by a wide margin in the first year, and one would guess all subsequent years. With such attractive returns possible, Buffett would gladly choose this stock over a bond, but this stock is not necessarily safe at any price. In fact, as the stock price rises, the coupon returns fall and become less attractive. Let's suppose the stock traded at $40 instead of at $20. Yearly coupon returns would be 1/2 as rich as before. In fact, the stock would not offer bond-beating returns for potentially several years. If bond yields stood at 6%, this stock would not offer a coupon yield that handily beat bond returns until 2005. As an investor, you would have to wait 5 years before the stock offered bond-beating results. Also keep in mind that this rate of return scenario hinges on the company's ability to increase earnings at 25% annual rates. If the company cannot sustain a high growth rate, you must temper the rate of return assumptions. Moreover, interest rates could rise to 7% and suddenly decrease the attractiveness of the company's earnings record. You could easily overpay for this company's coupon stream and experience inferior, perhaps negative, stock price returns. In Buffett's mind, you left yourself with little margin of safety. To be sure, the company's yearly coupons stand a good chance of eventually beating bond yields. As long as yearly profits keep rising, the company will present a potentially better investment opportunity than a fixed coupon bond can. If you could hold this stock for several years, you are virtually assured of bond-beating results, your original goal. But to better ensure success, focus as much on the price you pay for the stock as on the company's earnings stream. 6 rules for comparing stocks to bonds. In my previous book, Wall Street on Sale, McGraw-Hill, 1999, I devised a set of rules that allow you to place bonds and stocks in their proper context. Because this context is crucial to understanding Warren Buffett's methodology, I summarize these rules here. 1. Your overriding goal as a stock investor is to find companies whose returns can beat inflation. 200 years of market history have proven that stocks offer a nearly guaranteed means of beating inflation. 2. Your secondary goal is to beat the risk-free returns of government bonds, which are already priced to anticipate inflation. If the stocks you select cannot beat a bond return, you are better off putting your money into bonds. 3. The proper way of comparing a stock's potential return to a bond's return is to compare their respective coupons, that is, the money that can be generated on your behalf each year. When evaluating a bond, the relevant return is the yearly coupon. When evaluating a stock, the relevant return is the earnings you predict the company can produce each year going forward. 4. When possible, you should try to buy a stock whose current earnings yield, that is, current earnings divided by price, is near or above yields on a long-term bond. If interest rates are 6%, you need an earnings yield close to 6%. That is, the stock's P/E ratio should be at or under 17. If rates are 8%, you should look for companies priced at 12.5 times earnings or less. 5. The only time you should accept earnings yields that are lower than bond yields is when the company is growing and is expected to generate an earnings yield that would soon surpass bond yields. A high growth rate compensates for a low earnings yield, but the company's coupon yield should still compare favorably to a bond within a few years. If you must wait 5 years or more for earnings to catch up to bond yields, you are likely overpaying for the company. 6. Buying growth companies at the cheapest possible price is the best way to ensure that you can beat bond yields by a wide margin. You should try to take advantage of the compounding effect of earnings growth, which provides a higher and higher rate of return on your initial investment. Continuous growth in earnings leads to continuous growth in the return on your investment, which should lead to higher and higher share prices over time. Chapter 14. The Benefits of Avoiding Losses. Chroniclers of Buffett's achievements have commented that his sterling track record, when gauged from a rear-view mirror, seems relatively straightforward. Anyone with the patience, mathematical knowledge, and diligence to screen stocks could have roughly approximated Buffett's results, they say. Indeed, knowing what we know now, and having Buffett's entire career sliced and diced over 1,000 or more news articles, much of what he attained seems elementary in retrospect. Buffett would be the first to acknowledge that, although he possesses unusual mathematical gifts and is wired a little differently than most, thus permitting him to glean relevance from information others would overlook, the principles he applied could be mastered by virtually anyone with a grounding in finance. After all, how difficult can it be to find, say, a stock trading at 1/2 the value of its balance sheet cash, or a takeover deal that guaranteed a 50% annualized return, or a stock such as Coca-Cola trading at 12 times earnings, or a convertible preferred that could potentially double one's money within a few years? These types of situations, like lava from Mount Kilauea, bubble to the surface every day on Wall Street, waiting to be exploited by any investor who can find and understand them. Make no mistake, every great investor's motives, strategies, and results look crystal clear in retrospect. Peter Lynch's marvelous years running the Magellan Fund appear much less incredible judged from the skybox of history. He bought and sold common stocks like the rest of us, including many of the same types of stocks you probably placed in your own portfolio. Why, then, did Lynch attain vastly superior results? We tend to overlook the fact that the success of investors such as Lynch and Buffett derived from thousands of critical decisions they made over the course of decades, many of which were made on the fly, but the majority of which were correct. In our quest to find shortcut answers to how they did it, we tend to look at only the beginning, that Buffett started with $100, and at the end, his $30 billion fortune, and dismiss the daily rituals that got him from point A to point B. Those rituals, however, are what pushed Buffett's returns well above those of the crowd. If everybody had seen what he had seen, he wouldn't have made huge gains from his visions, Forbes magazine once wrote. A typical investor who spreads his or her money over a basket of stocks can expect to achieve 10 to 12% annualized gains over great periods. That's a well-known platitude. The same investor who focuses on the types of stocks Buffett owns, Coca-Cola, Gillette, capital cities, Wells Fargo, etc., could expect to gain perhaps a few percentage points more each year. These stocks have shown a tendency to outperform the market over long periods because they exhibited growth rates greater than the average U.S. corporation. A shrewd, full-time investor who focused on Buffett-like stocks and made sure to buy them at wonderfully cheap prices could add a couple of extra percentage points of gain a year. But the combined effects of these strategies still don't come close to producing the 33% compounded annual gain Buffett attained between the mid-1950s and the late 1990s. There has got to be more to the story. The power of avoiding losses. Buffett once summarized the essence of successful investing in a simple quip. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Losses occur for 3 primary reasons. 1, you took bigger risks and exposed yourself to a higher probability of loss. 2, you invested in an instrument that failed to keep pace with inflation and interest rates. 3, you didn't hold the instrument long enough to let its true intrinsic value be realized. There aren't many ways an investor can avoid periodic losses. The best way is to invest all of your assets in bonds and hold them to maturity. You would, of course, experience an erosion in the value of the bond due to inflation. If interest rates rise during your holding period, the intrinsic value of the bond would fall, and the yearly coupon wouldn't fully compensate you for inflationary pressures. To reduce the chance of losses, you must minimize mistakes. The fewer errors made over your investing career, the better your long-term returns. We've already seen the advantage of adding extra points of gain to your yearly returns. Earning an extra 2 percentage points a year on your portfolio compounds into tremendous amounts. Beating the market's presumed 11% yearly return by 2 percentage points would translate into hundreds of thousands of dollars of extra profits over time. The same holds true if you can avoid a loss. When you lose money, even if just for a year, you greatly erode the terminal value of your portfolio. You consume precious resources that must be replaced. In addition, you waste precious time trying to make up lost ground. Losses also reduce the positive effects of compounding. The loser's game. It's a sad fact that most day traders lose money over time, as do most bond, options, futures, and commodities traders. Research has clearly shown that long-term returns are tied to your holding periods and to the price you pay. Excessive trading and a disregard for fundamental risks serve as a weighty anchor that keep short-term oriented investors from consistently performing well. They strive so hard to compete at what are essentially zero-sum games that they unwittingly tax their performance into obscurity. Over time, their winning trades likely equal their losing trades, but they will continually lose a fraction of their money to taxes, commissions, and dealer spreads. Analyst and author Charles Ellis, in a 1975 article published in the Financial Analyst's Journal, was the first to label investing a loser's game. He foresaw how the field of investing, particularly at the institutional level, would ultimately degenerate into a momentum-based tournament where tens of thousands of individuals claw over one another trying to buy undiscovered stocks ahead of their peers. A game with so many participants, all trained to look at information the same way, would naturally tempt investors to make unforced errors, to borrow a term from tennis. Ellis neatly summed up his findings in a formula that showed how the pursuit of market-beating gains naturally led to inferior returns among fund managers. To beat the market, fund managers first had to beat each other and had to increasingly engage in short-term momentum trading to do so. Ultimately, these managers predetermined their own poor results and occasionally caused huge losses. Ellis concluded that the most successful investors are not necessarily the smartest people or those with million-dollar research budgets. Nor are they the ones who luckily scored 1,000% gains on a single stock. Rather, they are the ones who make the fewest mistakes during their careers. The belief that active managers can beat the market is based on two assumptions. 1. Liquidity offered in the stock market is an advantage, and 2. Institutional investing is a winner's game. My unhappy thesis can be briefly stated. Owing to important changes in the past 10 years, these basic assumptions are no longer true. On the contrary, market liquidity is a liability rather than an asset, and institutional investors will, over the long term, underperform the market because money management has become a loser's game. Golf provides an excellent example of a loser's game. The winner of a PGA tournament on Sunday is not necessarily the longest hitter, the best putter, nor has the best short game. The winner is the one who makes the fewest mistakes during the 4 rounds. That fact alone differentiates golf from most contact sports such as football or hockey. In contact sports, and even in tennis, the outcome of the game is determined by the winner, who presumably overpowers the opponent with skill and muscle to score the most points. In golf, the actions of the loser determine the outcome. Tiger Woods wins tournaments mostly because all his opponents, who never compete directly with Tiger during the weekend, make more mistakes than he does. Tiger could shoot 10 under par and lose the tournament if one of the 64 other players happens to make fewer mistakes and shoots 11 under par. The final outcome is really outside Tiger's control. He must rely on others to make more mistakes on the fairways than he does. Bowling operates under similar rules of engagement. Each contestant starts with a theoretical perfect score of 300 and loses points as more pins are missed. The final outcome of the match is determined by the loser, the person who misses the most pins. If you understand the rules of losers' games, you have taken a critical first step toward success in investments. Warren Buffett sits atop the financial world because he has made the fewest mistakes over his 40-year career. His most common mistakes, he admits, are sins of omission in which he failed to buy a stock that rallied or sold a stock too soon. Neither type of mistake cost Buffett cash. They are simply lost opportunities. If I polled 1,000 investors and asked them to list their top 5 rules for success, their answers would differ from Buffett's. Here is what they would probably say. Rule 1, take a long-term perspective. Rule 2, keep adding money to the market and let the magic of compounding work for you. Rule 3, don't try to time the market. Rule 4, stick to companies you understand. Rule 5, diversify. I would venture to say that few investors would think to mention Buffett's cardinal don't lose money rule. Some investors, sadly, refuse to believe that losses can occur, so accustomed are they to the unprecedented rally in the major indexes since 1987. Surveys done by mutual fund companies during the past few years indicate that a high percentage of individual investors still don't believe that mutual funds can lose money, or that the market is capable of dropping more than 10% anymore. Other investors see losses as temporary setbacks or as opportunities to add to their positions. Still others, acting out a psychological defense mechanism, try to avoid losses by violating their own rules. They let the ticker tape infect decision-making and trade in and out of winners and losers to avoid the psychological trauma of having to report a loss. Avoiding losses is probably the most important tool for long-term success in investing. No investor, even Buffett, can avoid periodic losses on individual stocks. Even if you resigned yourself to buying only at incredibly cheap prices, occasional mistakes will still occur. What differentiates Buffett from nearly all other investors is his ability to avoid yearly losses in his entire portfolio. Diversification alone can't prevent losses. All diversification can do is minimize the chances that a few stocks implode and drag the performance of the portfolio with them. Even if you hold 100 stocks, you are forever vulnerable to market risk, the risk that a declining market causes nearly all stocks to drop together. Most investors use the market as their mechanism for avoiding losses. They simply sell when a stock falls below its break-even point, no matter the fundamentals. One highly touted strategy of the 1990s, espoused by Investors Business Daily, implores investors to sell any issue that falls more than 8% below its purchase price, irrespective of events. Market timers rely on similar strategies. They make short-term bets on the direction of individual stocks and are prepared to exit quickly if the market turns against them. These strategies ultimately degrade into a form of gambling, where the odds of success shrink because the investor's holding period is too short. Other investors avoid losses by continuing to hold poor-performing stocks, sometimes for years, until they rally back above their original cost. To profit from this strategy, you must pin your hopes on the markets ultimately validating your decision. Warren Buffett would rather not place his faith in the hands of investors and traders. The methods he uses to lock in yearly gains take the market out of the equation. He reckons that if he can guarantee himself returns, even in poor markets, he will ultimately be way ahead of the game. Chapter 15. Avoiding Losses 2. Market Timing, Convertibles, and Options. Keeping abreast of market conditions. Again and again, Warren Buffett will tell you that he is not concerned about day-to-day fluctuations in the stock market. It doesn't matter to him whether the Dow Industrials rises 300 points in a single day or falls by the same amount. He doesn't care whether interest rates rose or fell for the day, or whether his portfolio declined $200 million in value. A frequent occurrence in 1999, by the way. The market is there only as a reference point to see if anybody is offering to do anything foolish, he was quoted saying in 1988. When we invest in stocks, we invest in businesses. However, Buffett, whether by accident or calculation, must be recognized as one of the most astute market timers in history. His ability to sense great perils in the market or see great opportunity when others see peril sets him apart from even the legendary market timers such as George Soros or Michael Steinhardt. It is also a chief reason he rarely suffers a yearly loss in his portfolio. His ability to find bargain stocks is well documented. Less known is his success in gauging market conditions and profiting from them. When Buffett begins talking up or down the market, it pays to listen. His form of market timing is similar to Wayne Gretzky's approach to hockey. Don't go where the puck is, go where it's going to be. The great investors of the 20th century all seemed to have a penchant for discovering undervalued securities, but they also were forward-looking. When a recession was underway, they didn't brood. They looked for signs that a recovery was at hand. And when the economy was strong, they stayed mindful of the risk of a slowdown and planned accordingly. When playing the market, they looked for catalysts that could propel an industry ahead, even when Wall Street had turned negative on the sector. Conversely, they wouldn't wait for boom times to end, but would sell ahead of others. Warren Buffett owes his success through the years as much to what he didn't buy as to what he did. Likewise, what he sold, and when he sold it, played just as prominent a role in his returns as did decisions to buy and hold Coca-Cola, Geico, or Gillette. Whitney Tilson of Tilson Capital Partners in New York, a frequent columnist to the Motley Fool website, reminds us that Buffett made no fewer than 4 distinct market timing calls in his career, each of which proved correct and highly profitable. Market Call 1. Selling out before the early 1970s bear market. Beginning in 1968, Buffett began to express sincere worries over stock prices. Writing near the peak of the go-go market of the 1960s, Buffett seemed to sense imminent danger to investors. Unable to find enough quality stocks at reasonable prices, he folded his investment partnership in 1969, acknowledging that his form of diligent, research-intensive stock picking couldn't compete in a momentum-fed, short-term-oriented market. Spectacular amounts of money are being made by those participating in the chain-letter-type stock promotion vogue. He wrote his clients, "The game is being played by the gullible, the self-hypnotized, and the cynical. I believe the odds are good that when the stock market and business history of this period is being written, this phenomenon will be regarded as of major importance and perhaps characterized as a mania." Frustrated by the lack of sensible pricing and the inability of value-oriented managers to make headway amid a sea of momentum-hungry fund managers, Buffett liquidated clients' accounts, put most of his personal wealth into Berkshire Hathaway stock, and stayed mostly out of the money management business for almost 5 years. He stayed on the sidelines while Americans experienced the most brutal bear market since the crash of 1929 to 1933. Market Call 2. Going long in 1974. 5 years after the market had peaked, most Americans had turned disillusioned by the stock market. The average portfolio had dropped 40% or more in value. Investors holding the great blue chips of the day, Xerox, Walt Disney, IBM, General Motors, and Sears Roebuck, for example, saw their portfolios decline more than 60% during the crash of 1973 to 1974. To investors caught in the middle, it seemed like there was no end to the panic selling. Some individuals tried holding their stocks, waiting for a rebound that never took place. Exhausted, they gave in and sold after watching their portfolios lose 50% of their value. The rest took their cues from the market itself. Daily declines reinforced a selling mentality. Selling begat selling, and an orderly market turned into a vicious cycle of losses. At the bottom, in 1974, few investors could be coaxed to re-enter the arena. But Buffett, refreshed from a 5-year hiatus and sitting on plenty of cash, dove headlong into the same stocks the market could no longer tolerate. Like a boy in a candy store, Buffett found more values than he could possibly digest. An investor who plunged into the market at the 1974 low made a 74% return within 2 years. Market Call 3. Seeing the opportunities that would open up in the 1980s. By 1979, the Dow Jones Industrial Average traded no higher than it did in 1964, 15 years without a single point gain. Pessimism hit extreme levels. The public had gradually shifted their portfolios into bonds, real estate, and precious metals, and brokers found it difficult to peddle even stocks with 15% dividend yields. Leading market strategists of the day, predicting more of the same financial morass, implored investors to buy bonds and avoid stocks. Buffett saw things differently. From his perspective, quality blue-chip stocks were being given away. Some sold for less than their book values, despite the fact that economic prospects for the United States still appeared bright. Corporate returns on equity remained healthy, blue-chip earnings were advancing at double-digit rates, and the speculative frenzy that had destroyed the integrity of the late 1960s markets had finally been removed from the equation. Stocks now sell at levels that should produce long-term returns superior to bonds, he told shareholders. Yet pension managers, usually encouraged by corporate sponsors that must necessarily please, are pouring funds in record proportion into bonds. Meanwhile, orders for stocks are being placed with an eyedropper. How right Buffett was. As Tilson pointed out, the stock market has returned an annualized 17.2% since Buffett penned those words. Bonds returned 9.6%. Market Call 4. Avoiding the 1987 Crash. By the mid-1980s, Buffett's buy and hold philosophy had been carved in stone. He maintained large stakes in his three favorite companies, Geico, Washington Post Company, and Capital Cities ABC, which later merged with Walt Disney, and pledged to hold these inevitables, as he called them, forever. He didn't share the same convictions about the rest of the stock market. At the Berkshire Hathaway annual meeting in 1986, Buffett lamented that he could not find suitable companies trading at low prices. Rather than dilute his portfolio with short-term stock investments, and given the fact that Buffett's stock holdings had already provided him tens of millions of dollars in gains, Buffett opted to take profits and shrink his portfolio. "I still can't find any bargains in today's market," he told shareholders. "We don't currently own any equities to speak of." Just 5 months before the 1987 crash, he told shareholders of his inability to find any large-cap stocks offering a high rate of return potential. "There's nothing that we could see buying, even if it went down 10%. In retrospect, Buffett's comments about a 10% decline ultimately proved conservative. 5 months after telling shareholders of his dilemma, the stock market lost 30% within a matter of days. His decision to whittle away his portfolio slowly before the crash undoubtedly kept Berkshire's stock portfolio from imparting too big a negative influence on book value. Buffett entered the 1980s energetic, ready to dive into a market he saw as woefully underappraised. As the market rose in value without pause, Buffett's conservatism got the better of him. By 1987, he was holding large stakes in just 3 stocks. When the decade began, Buffett had amassed large positions in 18 different companies. Warren Buffett does not possess a magic formula for determining when the stock market is grossly overvalued or undervalued. By all accounts, his decisions to plunge into or escape from the market are based on several common-sense factors. The relationship between stock yields and bond yields. Recall from Chapter 13 that Buffett covets stocks that offer earnings yields that can surpass bond yields over time. When bond yields are rising and threaten to overtake stock yields, the market is generally overvalued. When stocks fall to the point where their earnings yields, the inverse of P/E ratios, are above bond yields, they are most attractive. The rate of climb in the market. History tells us that the stock market cannot outperform the economy for very long. That is, you shouldn't expect corporate sales, earnings, or share prices to rise at rates in excess of economic output. If stock prices are rising at, say, 4 times the rate the economy is expanding, the market is primed for a fall at some point. Conversely, if stock prices are falling while the economy is surging, an undervalued condition may be opening up. Earnings multiples. In 1982, the P/E ratio of the S&P 500 index was just 7. Americans were willing to pay just $7 for every $1 corporations earned on their behalf. By mid-1999, Americans were willing to pay $34 for every $1 of earnings generated by these same companies. What explained the disparity? Falling interest rates accounted for some of the increase in P/E ratios. Declining rates make every $1 of earnings worth more to an investor. Improved profitability also accounted for some of the increase in PE. By the late 1990s, corporate returns on equity and assets had reached 70-year highs. It stood to reason that $1 of earnings carried more value because corporations could reinvest earnings at high rates. Yet the majority of the climb in stock prices can be attributed to emotion, the sheer willingness of investors to pay higher and higher prices without regard to value. When PE ratios are expanding faster than what could be expected, given changes in interest rates and corporate profitability, investors must be on the alert for a correction. The state of the economy. When the economy is running full throttle and there seems to be little chance of it sustaining present growth rates, investors should ponder whether to decrease their exposure to the stock market and find alternatives. Likewise, during tough economic times, stocks usually fall to bargain levels and offer high rate of return potential. Using Buffett's 15% rule, you can quickly gauge whether stocks are worthy of holding. The general rule is to buy during a recession, when PE ratios are at their lowest, and to sell when the economy can't get any stronger and PE ratios are their highest. The big picture. Because Buffett endeavors to hold a stock for several years or more, he must take a more holistic view of companies, industries, and the entire market before buying. Buffett won't buy or sell a stock in response to near-term changes in a company's profitability, nor will he pin his hopes on a sector catching fire on Wall Street to sell at a higher price. Instead, he assesses longer-term fundamentals in the economy and the market and examines whether those fundamentals can support higher stock prices. If a stock doesn't offer the potential rate of return he seeks, he is likely to sell the security or avoid buying. Buffett prefers to play an economic cycle to the fullest whenever possible. During a recession, when nearly all U.S. industries are experiencing a downturn, Buffett is apt to load up on numerous stocks, knowing that several consecutive years of improved profitability lie ahead. When the economy peaks and odds favor an eventual slowdown, selling is the prudent course. Convertibles. Some of Buffett's most lucrative investments in the late 1980s and early 1990s involved convertibles, which are hybrid securities that possess features of a stock and an income-producing security such as a bond or preferred stock. He made 5 publicized convertible investments starting in 1987, Salomon Brothers in 1987, Gillette in 1989, American Express in 1991, Champion International in 1989, and U.S. Air Group in 1989. Combined, the 5 convertibles have provided more than $5 billion in gains and prompted Buffett to take larger stakes in 3 of the companies. He still holds all the common shares of Gillette and American Express that converted, and dovetailed his Salomon Brothers investment to obtain large stakes in Travelers Group and Citigroup. When you buy a convertible issued by, say, Gillette, you get a fixed income stream, just as you would with a bond, but you also possess the right to convert your bond into a fixed number of shares of common stock. The conversion feature makes these investments most attractive, despite the fact that the convertible price is usually 15 to 25% above the common stock's price, and the coupon rate on the bond is usually below prevailing bond rates. Say you pay $1,000 for XYZ Corporation's bond and have the right to convert it to 20 shares of XYZ stock, a conversion price of $50 per share. XYZ shares sell for $40 each. Multiply $40 by 20 and you get $800. You're paying a premium of $200. The income component, whether in the form of a bond coupon or a preferred dividend, defrays the premium paid. With a convertible, you're betting on the appreciation of the common stock to kick up your returns. If XYZ's shares rise to $50 or above, the convertible is said to be in the money. $50 per share times 20 shares equals $1,000. Each $1 advance in the common stock should lead to $1 increases in the value of the convertible. You can choose to convert and sell your common shares for a profit. You also have the option of converting but holding on to your common stock, or letting profits ride by holding the convertible. Because there is a bond component to the security, a convertible shouldn't decline as much as the common stock. Theoretically, the security won't fall below the face value of the underlying bond, no matter how low the common stock drops, unless the company faced financial distress. Buffett will invest in convertibles when the combination of dividends and stock appreciation potential offers a market-beating return. Under almost any conditions, we expect these preferreds to return us our money plus dividends, he wrote in his 1989 annual report. If that is all we get, though, the result will be disappointing because we will have given up flexibility and consequently will have missed some significant opportunities elsewhere. The only way Berkshire can achieve satisfactory results from preferred issues is to have the common stocks of the investee companies do well. Options. On a number of occasions, Buffett has expressed his disdain for derivative securities such as futures and options contracts. Because these securities are bets on shorter-term price movements within a market, they fall under the definition of gambling rather than of investing. An investor in a put or call option, for example, is making a timing bet on the near-term direction of a stock and is trying to magnify the gains through leverage, that is, not having to put up the full amount. For example, an investor who thinks that shares of America Online, priced at $50, will rise, may buy a call option with a strike price of $50. That gives him the right to buy the stock from the option seller for $50 per share, regardless of America Online's price at the time, before the options contract expires. Let's say the investor paid a premium of $5 for the right to exercise this option. His total outlay is $500, each contract covers 100 shares, that he cannot recover. If America Online rises above $55, the $50 strike price plus the $5 premium paid, by expiration, the contract will make money. Should the stock reach $60, the option would be valued at $10, $60 minus the $50 strike price, a doubling of the investor's principal. At a price of $70, the option is worth $20. All it took was a 16.6% increase in the stock to cause a doubling of the option's value. An investor in a put option attempts to do the opposite. Rather than obtain the right to buy the stock at a fixed future price, the put buyer wants the right to sell the stock at a later date and seeks to lock in the price up front. He'll pay a premium for the right to sell the stock that will make money if the stock falls enough to more than cover the cost of the premium. If Warren Buffett does dabble in options, and if you doubt he could dabble successfully, he does so quietly. He once acknowledged writing put options on Coca-Cola's stock. At the time, he was thinking of adding to his stake in the soft drink company. This occurred in April 1993, when Coke stock hovered around $39 per share before splits. Buffett was out to acquire several million more shares of Coca-Cola. He already owned 93.4 million shares, but was fearful that the stock would rally and run away from him. He wrote puts covering 5 million shares at an exercise price of $35. Buffett collected a $7.5 million premium, $1.50 per option. By using options, Buffett was attempting to get more shares of Coke on the cheap, and in the process collect a premium to defray his costs. It worked this way. If Coca-Cola's stock crashed before the option expired, the buyers would put the stock to Buffett, forcing him to take 5 million Coke shares off their hands for a net price of $33.50 per share. the $35 strike price minus the $1.50 premium. That suited him fine because he wanted the shares anyway and hoped they would fall in price when it came time to buy. However, had Coke stock risen in price, the buyer would have let the option expire worthless. No stock would have changed hands, but Buffett would have pocketed the $7.5 million premium, which is exactly what happened. The stock rose past the point at which Buffett wanted to buy, and he walked away with $7.5 million, but knowing that he did not overpay for Coca-Cola. Buffett would have to wait another year for the chance to buy Coca-Cola again. In 1994, he increased his then 93.4 million share stake to an even 100 million, which split in 1996 to become 200 million. This was the only time the press has made note of Buffett's foray into options, although he probably has used options numerous times in his career. It's likely he hedges future purchases of stock by selling put options ahead of his purchase. This gives him a locked-in premium and a chance to buy his favorite stocks while they are in decline. Mathematically speaking, the use of options in trying to obtain Coca-Cola stock represented a win-win situation for a value hunter such as Buffett. It would not be surprising to learn that Buffett tries to obtain many of his new stocks in this manner. Chapter 16. Warren's Secret Weapon: Arbitrage. Given the secrecy surrounding Buffett's early career and the scant press attention paid to his activities, few understood just how this young, waggish crew-cut figure from Omaha consistently beat the Dow Jones Industrial Average. Buffett's chums from the Graham School of Investing knew, of course, that the market was beatable, not just because Graham said it was, but because some of them were proving it with their own money. But the outside world, with nothing more to go on except the efficient market dogma that crept into business schools, could ascribe Buffett's year-after-year successes to nothing more than chance. It's as if they secretly wished that the Nebraska prodigy would stumble one year to prove his mortality and the market's invincibility. It didn't happen. Not only did Buffett continue to beat the major market averages, but he suffered few single-year declines along the way. That second accomplishment is by far the more remarkable. Statistics tell us that any investor who buys and sells hundreds of stocks over a period of decades and leaves himself vulnerable to the near-term vagaries of the market has a perfect 100% chance of posting some yearly losses. It stands to reason that no matter how well chosen one's portfolio, profits will be vulnerable to factors outside the investor's control. On October 19, 1987, when the Dow Industrials fell 508 points, more than 97% of all stocks fell in price. Perhaps 1 in 1,000 ordinary investors made money that day. Perhaps 1 in 10 made money the whole year. Because the market has a tendency to fall once every 4 years or so, an average investor can expect 10 yearly losses over a 40-year period. A great investor might be able to reduce the number of yearly losses to 5 or 6. Buffett's scorecard shows that he has increased the book value of Berkshire Hathaway stock 35 consecutive years. In only 4 years did the S&P 500 index beat the growth of Berkshire's equity. This is similar to 40 years of par golf or better. There are only 3 ways an investor can attain a long-term, loss-free track record. 1. Buy short-term treasury bills and bonds and hold them to maturity, thereby locking in 4 to 6% average annual gains. 2. Concentrate on private market investments by buying properties that consistently generate higher profits and that can sell for greater prices each year. 3. Own publicly traded securities and minimize your exposure to price fluctuations by devoting some of the portfolio to unconventional, sure things. Stringing small gains together with takeovers. Right from the start of his investment management career, Buffett resorted extensively to takeover arbitrage, the trading of securities involved in mergers, to keep his portfolio results positive. In poor market years, arbitrage activities have greatly enhanced Buffett's performance and kept returns positive. In strong markets, Buffett has exploited the profit opportunities of mergers to exceed the returns of the indexes. Benjamin Graham, Buffett's mentor, had made arbitrage one of the keystones of his teachings and money management activities at Graham-Newman between 1926 and 1956. Graham's clients were informed that some of their money would be deployed in shorter-term situations to exploit irrational price discrepancies. These situations included reorganizations, liquidations, hedges involving convertible bonds and preferred stocks, and takeovers. One of Graham's first investments was a classic arbitrage. In 1915, at the age of 21, he bought shares of Guggenheim Exploration Company, a holding company priced at around $69 per share. Guggenheim owned minority stakes in 4 copper mining companies: Kennecott, Chino Copper, American Smelting, and Ray Consolidated. The Guggenheim stakes combined were worth more than $76 per share. Therefore, on paper, an investor was getting $76 worth of assets for just $69. Graham reckoned that the situation could not continue indefinitely because Guggenheim stock had to rise to at least $76, which would give him a locked-in $7 per share profit. The word arbitrage in the strict sense refers to the simultaneous buying and selling of a security or related security in 2 different markets to capture irrational price movements. For example, if Hewlett-Packard stock was selling for $80 on the New York Stock Exchange and for $82 on the Pacific Stock Exchange, an arbitrageur would buy all the Hewlett-Packard stock he could get his hands on in New York and make arrangements to sell it on the Pacific Exchange, locking in a $2 profit each time. The rub is that these opportunities, when they arise, don't last very long. Systematic purchases of Hewlett-Packard stock in New York would drive up the price on that market, while concurrent selling on the Pacific Exchange would drive Hewlett-Packard's quote down. Both markets would quickly reach parity again. Takeover arbitrages operate in roughly similar ways. In effect, you are trying to capture the spread between the market price of a stock and the deal price. That is, the price at which one company has agreed to pay for another. Merck, for example, might offer $85 per share in cash to buy Pfizer. If Pfizer's stock trades at, say, $80, an investor has the opportunity to lock in a guaranteed $5 profit by buying Pfizer and holding his shares until the deal is approved, and then tendering them to Merck. The $5 profit represents a 6.25% gain on your $80 investment. If Pfizer's stock dropped below $80, the potential gain widens. The trick in takeover arbitrage is to maximize your annualized gain and minimize your chances of loss. Companies usually disclose up front how fast they think they can consummate the merger, which has a big impact in determining your returns. In the Merck example, a $5 profit translates into a 12.9% annualized gain if the deal closes exactly 6 months after your purchase. If the deal closes in 4 months, your annualized gain turns into a more attractive 20%. Once the deal closes and you have received your money from Merck, deploy the proceeds into another deal offering similar profit opportunities. By stringing together a succession of arbitrage trades, an investor can turn small percentage gains on each transaction into huge annual gains, providing all the deals work in your favor. If you can make 10% on consecutive deals that close in 3 months, your compounded return, assuming you reinvest all the profits from the previous deal, will be an astounding 46.4% for an entire year. There's no shortage of these opportunities. Between 10 and 20 mergers are announced every day on Wall Street, some of which have opened up fabulous profit-making bonanzas for investors sharp enough to spot them. Buffett has spoken sparingly of his arbitrage activity, except to say that he does it, especially when he has trouble finding good bargains, continues to do it, and has done pretty well at it. Truth be told, there are more than a few investment advisors behind bars for attaining, however illicitly, the gains Buffett scored legally playing takeovers. Buffett wrote that Graham attained a 20% annual return from arbitrage activities between 1926 and 1956, a result that would have destroyed the returns of the Dow Industrials. In 1988, Buffett claimed that his own returns from arbitrage to date had averaged well over Graham's 20%. While running his private partnership in the 1950s and 1960s, Buffett invested in arbitrage situations dozens of times. He recognized the superior returns possible from stringing together small percentage gains over and over. Most important, Buffett seems to have used arbitrage to protect his clients' portfolios from the vagaries of the stock market. By putting a large portion of their money into takeover situations, what Buffett routinely called workouts, he could reap abnormal gains without worrying about the general conditions of the market. Indeed, in a poor market, Buffett could expect his arbitrage positions to gain in value, or at least not decline. Knowing that he could insulate a good portion of clients' portfolios from losses, Buffett was free to concentrate the rest of their holdings into just a few stocks. Writing to his clients in February 1960, Buffett said that 35% of their money was tied up in one stock, which he declined to name. The rest was invested in undervalued stocks and workouts. To the extent possible, I continue to attempt to invest in situations at least partially insulated from the behavior of the general market. In general, workouts constituted the second largest component of Buffett's partnership portfolios. Whereas Buffett rarely told investors about the types of arbitrage situations he played, he openly acknowledged the volume of deals he transacted and that he borrowed money to make purchases. In 1990, Forbes unearthed financial filings made to state regulators by Berkshire Hathaway's insurance subsidiaries in an attempt to stitch together Buffett's yearly arbitrage activities. They sought out insurance records because Berkshire's insurance companies provide most of the cash Buffett needs to make new investments. Forbes found, for example, that Buffett used takeover arbitrage extensively in 1987 to keep Berkshire's investment portfolio rising in a highly volatile market. Interestingly, Buffett was significantly cutting the number of common stocks Berkshire held in its portfolio. Thus, at a time when ordinary investors were losing money on common stocks, Buffett was relying heavily on non-traditional investments to stay in the black. That year, Buffett played takeovers involving Kraft, RJR Nabisco, and Philip Morris, in addition to lesser-known companies such as Marine Midland, Federated, and Interco. He turned a $2.7 million bet on Southland into $3.3 million in 10 days for an annualized gain of more than 700%. In all, Forbes estimated that Buffett's arbitrage activities earned 90% in 1987, whereas the S&P 500 returned 5%. In 1988, Buffett bet on 20 different takeovers, netting a gain of 35%, more than twice what the S&P 500 gained. The following year, Buffett was not as fortunate, Fortune magazine reported. He lost 31% on takeover deals. He did not reveal this loss to shareholders, but had warned them the previous year that he planned to take fewer arbitrage stakes in 1989 because of extraordinary excesses in the takeover arena. The less the prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs, he wrote. Nevertheless, that year Buffett tendered part of his arbitrage stake in RJR Nabisco to take over specialists Kohlberg, Kravis, Roberts and Company. and sold the rest of his shares in the market for a combined $64 million profit. The Rockwood Cocoa Bean Bonanza. In 1954, his first year working for Graham, Buffett plunged into one of the more offbeat of his numerous arbitrage trades, and one of the few about which he has spoken freely. Rockwood and Company, a barely profitable chocolate maker, found itself in a squeeze when the price of cocoa temporarily soared tenfold, and the company tried to liquidate its inventory for a profit. The catch was that Rockwood faced a nearly 50% income tax on the sale. Luckily, that same year, the Internal Revenue Service allowed companies to avoid taxes on inventory sales if they sold their material to shareholders as part of a restructuring of the business. Taking advantage of the rule change, Rockwood announced it would sell its cocoa butter business and assigned 13 million pounds of beans to that division's inventory. As part of the deal, Rockwood announced it would repurchase stock from shareholders and give them 80 pounds of beans per share. With cocoa beans selling for 60 cents a pound, Rockwood was essentially repurchasing stock at $48 per share. Just before the announcement, Rockwood stock traded for just $15. Buffett seized the opportunity. He bought Rockwood shares on the open market, sold the shares back to Rockwood, and then sold beans he received in the exchange and used the proceeds to purchase more Rockwood shares. This enabled Buffett to profit continuously until the spread between bean prices and Rockwood's stock price evaporated. For several weeks, I busily bought shares, sold beans, and made periodic stops at Schroeder Trust to exchange stock certificates for warehouse receipts. The profits were good, and my only expense was subway tokens, Buffett said. General Dynamics. One of Buffett's most profitable investments on a dollar basis resulted from a routine arbitrage deal that turned to gold. In July 1992, defense contractor General Dynamics, then in the midst of a restructuring, announced that it would repurchase up to 30% of its stock in a Dutch auction at prices between $65.37 and $72.25 per share. General Dynamics has since split 2-for-1 twice. In previous months, the company had sold off 3 of its non-defense-related divisions, Data Systems, Cessna Aircraft, and Hughes Aircraft, and had raised $1.25 billion. As the U.S. military was gradually paring down and reducing orders to contractors, General Dynamics opted not to plow the $1.25 billion in proceeds back into the company. Instead, it made a bold move to reduce the number of shares outstanding and substantially raise per-share earnings for investors who wouldn't tender. Sensing an opportunity to make a few dollars profit, Buffett, buying through Berkshire Hathaway, accumulated 4.3 million shares of General Dynamics at prices averaging $72, $18 post-split. I had paid little attention to the company until last summer, when it announced it would repurchase about 30% of its shares, Buffett wrote in his 1992 annual report. Seeing an arbitrage opportunity, I began buying the stock for Berkshire, expecting to tender our holdings for a small profit. It was only after purchasing the shares that Buffett began studying General Dynamics and saw the unique turnaround being engineered by CEO William Anders. Anders had been wringing tens of millions of dollars of costs out of the company's operations by laying off several thousand employees, closing manufacturing facilities, and slicing research and development expenditures. Wall Street seemed elated with Anders' moves. General Dynamics stock had more than doubled off its bottom before the company announced the Dutch auction. Still, the stock traded below the company's book value, a point that caught Buffett's attention. Rather than tender his 4.3 million shares, Buffett hung on, believing that the stock had further rallying power. Over the next 5 years, the shares Buffett continued to hold would nearly quadruple in price. In addition, General Dynamics declared 3 special dividends in 1993 amounting to $50 per share, $12.50 post-split. Buffett's 4.3 million share purchase would have turned into 17.2 million shares after the splits, but Buffett sold 20% of his stake in April 1994 and then another 14% stake in August. He disposed of another 20% over the next 2 years. By 1998, Berkshire Hathaway held 7,693,637 shares of General Dynamics that at one point were worth about $530 million. The $50 per share dividends Buffett received and his pre-tax profits, including profits from shares sold between 1994 and 1997, totaled an estimated $450 million by mid-1999. "We were lucky," Buffett acknowledged after the fact. Buffett is by no means alone in what he does. Hundreds of professional investors worldwide make their living speculating on stocks involved in takeovers. They do little else but sit at terminals and watch news wires for announcements of a takeover. When one flashes across their screen, they quickly analyze the deal, form a strategy, and act. They may close the position within hours or days, depending on their goals. Some arbitrageurs will hold their stocks until the deal is consummated and they receive their cash or shares. From all indications, however, none has been as successful at capturing returns from deals as Buffett because he focuses only on sure-thing deals, which these days represent a smaller and smaller fraction of the mergers announced. Buffett also has the luxury of patience on his side. ARBs, in contrast, need to justify their existence by trading. They tend to react quickly to as many deals as possible, sometimes before the companies release all the details of the merger. Buffett, however, picks and chooses a few deals a year from among hundreds already announced. He is more likely to research the deal thoroughly and wait for a temporary dip in the target stock to lock in a guaranteed high return. Buffett also differs from other ARB specialists in that he almost always enlists on the side of the common shareholder. He takes positions after mergers are announced rather than use his clout and financial backing to force deals to occur, which was typical of takeover specialists in the 1980s. He never invests based on rumored takeovers either. Buffett's cardinal goal is to profit from the spread in price, not to take a controlling interest in the company and force a turnover of management. Nor is he interested in acquiring properties for the sake of busting them up into pieces. His role, as he sees it, is merely to exploit the attractive mathematics these deals offer. The deal itself is of no consequence to Buffett because he rarely cares about the companies in play. He simply senses opportunities for abnormal profits and pounces. Buffett's thoughts on forming good habits. I don't think you can be a really good investor over a broad range without doing a massive amount of reading. You might think about picking out 5 or 10 companies where you feel quite familiar with their products, but not necessarily so familiar with their financials. Then get lots of annual reports and all of the articles that have been written on those companies for 5 or 10 years. Just sort of immerse yourself. And when you get all through, ask yourself, what do I not know that I need to know? Many years ago, I would go around and talk to competitors and employees. I just kept asking questions. It's an investigative process, a journalistic process. And in the end, you want to write the story. Some companies are easy to write stories about, and other companies are much tougher to write stories about. We try to look for the ones that are easy. I consider there to be 3 basic ideas that, if they are really ground into your intellectual framework, I don't know how you could help but do reasonably well in stocks. None of them are complicated. None of them take mathematical talent or anything of the sort. Benjamin Graham said you should look at stocks as small pieces of the business. Look at stock fluctuations as your friend rather than your enemy. Profit from the folly rather than participate in it. And Graham said the three most important words of investing: margin of safety. I think those ideas, 100 years from now, will still be regarded as the three cornerstones of sound investing.